Well, thank you, everyone, for coming. I'd like to thank the TAC members for their willingness to attend on short notice. This meeting has not been on the calendars long, and I know you've had to work to make arrangements to be here. I'm thankful for that. I know we have a number of people on the phone as well, TAC members and Commissioner Chilton as well. And I want to thank the presenters. These are experts representing different aspects of the industry. They're going to provide us some thoughts and ideas about how we develop a technology solution going forward. And so I appreciate they're rearranging their own schedules to be here today and to put together some thoughtful presentations. We obviously want to get to the bottom of what happened. That there will be the Commission is investigating both MF Global, and we're pursuing legal action against Peregrine. But this group here today can help us develop technology solutions that will protect customer funds from fraud and misappropriation. To state that the meltdown of the two Futures Commission merchants within the last 10 months has shaken public confidence is an understatement. The actions taken by these two firms are a complete and total betrayal of the public trust and undoubtedly undermine investor confidence, so much that an immediate and comprehensive overhaul of the customer protection safeguards is required. Since the failure of MF Global in October 2011, the Commission staff has been working on multiple rule changes to increase oversight, reporting, and compliance among the FCM community. I support the reforms that will increase transparency, disclosure, and independent verification of customer funds, as well as subject FCM business practices to a higher level of public scrutiny. And I've kind of laid these out in a speech I gave back in January at New York Law School. In addition, I support reforming the bankruptcy code to ensure that the protection of customer money in court matches the rhetoric and promises found in press releases issued recently. However, the reforms currently under consideration by the Commission so far fail to close the existing regulatory gap that allows firms to self-report status, balance, and location of customer funds. In my opinion, it's imperative that the industry develop a technology solution that can verify customer balances held by FCMs, custodial banks, and the clearinghouses. This system must be fully automated to draw feeds directly from relevant entities to compare balances. If balances do not match, then an automated alert ought to be sent to the appropriate self-regulatory organization and the Commission. The solution must be 100% industry funded and maintained and overseen by the Commission and the SROs. I've called this emergency meeting for the expert witnesses to share their opinion about the feasibility of developing such a technology solution, as well as considering other solutions that can verify customer funds and where they are located. I hope the TAC members will not hesitate to offer their suggestions, thoughts, and opinions regarding today's solutions. Today's discussion will be in two parts. First, we'll hear from our panelists, 8 of them, and the second half of the day will be spent discussing the solutions. We're going to try to get everybody's presentations in the morning and then come back and kind of go over. We'll begin with our Director of Division of Swap Dealer and Intermediary Oversight, Gary Barnett, who will provide the overview of the draft rules that the Commission is considering today. After Mr. Barnett, we'll hear from Mr. Haymeyer, Chairman of the Board of National Futures Association, to present the solutions proposed by NFA to protect customer funds. We were going to go to Brian Durkin. He has missed his flight and will be here later from CME. Then we'll go to the two FCM representatives, Jerry Corcoran with R.J. O'Brien and Mike Dawley, Managing Director at Goldman Sachs. Then we'll go to our technology providers, Chris Shellhorn, President of Capital Confirmation, and Alan Green, General Manager of Capital Markets for SunGuard, about the feasibility of developing a technology solution that will make completely transparent to regulators the flow of customer money. Finally, we'll hear from Steve Hurst, CEO of Merchants Data Repository, who's proposed a third-party utility segregation model for our consideration. I fully expect today's discussion to help the Commission make critical decisions about technology-based fraud prevention systems, understanding what is needed and how soon it can be implemented, and who will be connected are but a few of the questions I have for the panelists today. I'm also open to other suggestions to place customer funds outside the FCM, but regardless of where we put the money, there must be a technology solution that will give customers certainty that their money is safe each and every day. When this is being this discussion is being not webcast, it's over a phone line, so when you introduce yourself or when you have a comment, please remember to introduce who you are so people can follow the dialogue over the phone. I think this is being recorded and then will be posted later, but it is not being live webcast. Tape delay, I guess, for language. No, that's not true. We will begin. Oh, let me turn. I know Chairman Gensler is going to join us a little bit later. We do have Commissioner Chilton on the phone, and I turn it over to him to make his opening remarks. Commissioner Chilton?
Thanks, Mr. Chairman. I'll be very brief, and I'll be on listen only most of the morning. I'll let you all know if I have questions. But thanks for everybody taking the time out of your schedule, and thanks particularly to Commissioner Amalia for him and his staff for organizing this meeting in such short order. And I agree with everything that you said, Scott, just to a T. Everything you said, I think, is right on the mark. It's clear that some of these futures firm fraudsters can cost a lot of people a lot of money when they put their minds to it. And we all need to, us at the CFTC included, need to do a much better job and have the right tools to protect customer funds. I've talked about it a lot, but I still think we need regular and robust deep data dives, and that's really what you're talking about, Scott, to make sure the customer's money is where it's supposed to be 24/7, 365. I also think, and this isn't a technology thing, but I think we need an insurance fund like the securities and banking worlds already have as a backstop for customers. Yesterday, people said, well, that's going to cost a lot of money. Well, that shouldn't be the end of the conversation. How much money is it going to cost? And do I care as a regulator if consumers or customers are protected? If it costs somebody some money? I mean, no, I want them protected. So I think we need more work on an insurance fund. And we need to make sure that we can't have the wool pulled over our eyes by somebody with Photoshop and a bottle of whiteout, for gosh sakes. In most sports teams, like when we watch the Olympics, a fake is a good thing, like with a ball or something, at least for the offensive team, but not so much for the defense, and really not so much for us regulators. We have to be able to see around corners, and sadly, we have to be very, very suspicious. We really need an Olympic-caliber regulatory oversight regime, and much of what's needed comes down to technology, and thus the meeting today. We need the technology to do those deep data dives and to make sure we're not being faked out. And we need good guys who are better at using the technology than are the bad guys. So thank you again for taking time for everybody to participate in the TAC, and thank you again, Scott, for your leadership. Thanks.
Thank you, Commissioner Chilton. Again, we will be joined by Chairman Gensler later, and he can make his remarks then. Let's get started. We'll go. We're going to start with Gary Barnett, Director of DSIO here at the Commission, largely responsible for assembling the regulatory reform solutions begun post-MF Global, and I think accelerated now that we've had the second problem. After that, we were going to go to Mr. Durkin, but Chris Haymeyer, who is our TAC. Chris is over here. So you're next. Gary?
Okay. Thank you, Commissioner O'Malley. As you said, we're working on multiple rule modifications to enhance customer protection, and I'll provide you with an overview of where we are so far. To kind of categorize the changes that we're working on, first we're trying to incorporate or federalize the NFA's recent Section 16. We think that it has some important changes to it that we ought to adopt as well. We were actually involved in discussions. We greatly appreciate the dialogue we had with them, and we think that the result they got with Section 16 is very helpful. In part, Section 16, and I just touch on it so I don't take away from NFA's discussion later, but so you understand where we're going categorically, it ends the Part 30 alternative method. It requires additional reports things like daily computations of seg and secured and twice monthly detailed reporting regarding cash and investment of customer funds. And then there's some data points on about the company itself, leverage and prop trading and so on. It requires policies and procedures and controls around disbursements from seg and secured. And these policies and procedures can cover things such as separation of duties and training. It's open to that. In addition, and I think this is a very powerful regulatory tool, the rule will require the FCM to engage in an analysis, which they'll have to document. It will be helpful to the regulators, both the SRO and the Commission, their analysis of the amount of excess they need to maintain in order to reasonably ensure that they will remain in seg and secured compliance at all times. And with the daily reporting, along with the analysis of the retained interest they should have given their business risk profile, would be very helpful to us. And then the rule's key feature in terms of concerns about disbursement are withdrawals on any day aggregating more than 25% of the targeted excess have to be approved by senior management and reported to the SRO, to NFA, along with the certification they remain in compliance with seg and secured requirements. So we want to bring those elements into our rule package. In addition, we want the SROs and ourselves to have direct read-only access to FCM bank and custodial accounts for customer funds 24/7 and without FCM permission. So we think that this ability to tap into the core information may be important to this project that the TAC is looking at. We also want more transparency to regulators about the FCM's operations. We want more trend and risk information. We will be requiring reporting of material changes in the business or relevant affiliates that could have a material adverse effect on the FCM. And that's going to require a balance, and we're working on it because we know that we've seen examples where the corporate structure of an FCM, there's not a lot between the affiliates, and what's going on at an affiliate has a very significant and direct effect on the FCM. We also know that some of you have a plethora of affiliates, and some of them are not so relevant. So finding the right balance and getting that right is important, and we're looking at that. We're looking for more transparency to customers about their funds, the counterparties they use, and even the FCM itself. We think customers should have even greater access to information about how their assets are held and with whom, and we think they should have more information about the business of the FCM, that the information about the elements of the business that can create risk to the customers. And one thought that we have talked about here internally quite a bit is that investors who go to mutual funds or they invest in a company, they get a lot of information about the material risks they're taking on when they put their funds into that entity. We think that customers who entrust their funds to an FCM should have similar information so that they can make an evaluation of the FCM they're choosing. And the corollary then to this is that if the oversight has to take into account risks and controls and policies and procedures and so on, take more information into account, then so must the examination process follow. So we're working on various initiatives to enhance our examination process, and more information about those initiatives in terms of the examination process will come out in the near future. And that's my summary. Mr. O'Malley, Commissioner O'Malley.
Great, thank you. I think for the technology aspect of this, and this is why we're here, you mentioned giving SROs and CFTC direct electronic read-only access for FCM bank and custodial accounts for customer funds 24/7 without FCM permission.
Yes, sir.
What does that mean exactly? How will we do that? What do you have envisioned? And obviously we've assembled this group and you've laid out something similar to what I'm thinking about, but we want to tackle it. Do you have an idea in mind that maybe we can further discuss here?
Yeah, our idea is, without the benefit of this group, ours is starting with the acknowledgments we get from the bank about the account acknowledgments, about the account as a seg account or a secured account, so on and so forth.
And how do we receive that today?
How we receive it currently is it's received at the SRO, and it's sometimes held by the FCM. So obviously we will have to have that directly delivered to us, and then we will have to call to confirm that it was in fact sent to us by the depository. So what we currently do versus what we will do are different.
What we received today, can it be faxed? Is it emailed? How do we receive it today? Does it populate any of our systems? What is our technology solution? What do we have in terms of technology? What is our technology baseline, if you will, and where do we have to be?
We're talking about getting it through the Windjammer system, but again, in terms of legal obligation to deliver it versus the process of delivering it, how we'll deliver it has not been nailed down. So if there are ways to improve on how we do it, we do know based on recent experience that we need it delivered directly to us from the bank. We know that we need to call back to confirm that it came from the bank, but the methodology, whether it's an email, whether it's a fax, we haven't nailed that down. So we are open to discussion or improvement in that regard.
Do you want to just briefly state what Windjammer is?
Yeah, it's a system that's up that FCMs submit filings to us through that system. It's an electronic system,
run by NFA, built by NFA, correct?
Yes.
And CME.
I could use some help from one of the FCMs on that, but yes, I think that's right.
So your vision is.
Yeah, so to finish the thought then is that the bank would have the depositor's consent right in that acknowledgement, and the bank would be agreeing right then and there that going forward we would have.
The depositor in this case, is it the FCM or the customer?
It's the FCM on behalf of the customer. So around those accounts, the FCM would be agreeing, and the bank would be agreeing at that moment in time, locking in the agreement that we would have access without further subsequent permission, that we would have that access 24/7 going forward, and then we want it electronically as well.
Having a bank, you've kind of, I want to be clear about this, you've kind of stated two things. One, that we would have 24/7 access, which it would imply that we could go in and check balances. You've also said they would have to, push essentially data to us. What is your preference? Do you want to have the capacity to look in and survey each and every account, or do you want periodic, regular?
No. We want online access. We want basically be able to give us our own password and let us go online and go into and look at the account balance.
How many people will it take to check using our own password? I mean, I have a bank account. I can go check it. Frequently I forget my password and I get locked out. It takes time. Where are we going to get the people to go checking balances? And if we're going to check one FCM with one versus one custodial bank, how many customers and how many accounts are there out there? Can we feasibly do that?
No, you're absolutely right. What you're implying in your question is absolutely right. You remember in a recent case with an FCM that came under stress and was happily resolved in a good way. We had to transfer the business. We were watching the seg and secured balances on a real-time basis, and it really took a single person to just track all of the things that were going on while we're in that sort of stress period of moving that entity. So it would be labor intensive for an individual or a staff to be sitting there watching those numbers or watching for great variances. So I think what is implied in your question is right, that it would take to watch all FCMs and watching all transactions, and when you hear probably from your participants the numbers of accounts and things that are there, I mean, it would be to the extent that you can cover some of that electronically or all of it would be fantastic. But it would be very labor intensive.
Yeah. Cliff, I'd like to recognize you, but I've broken my own rule already. We're going to hear from panelists, then we're going to do questions. But I think it's important we flesh out exactly what is the baseline the commission is looking for. So that's why I've probed a little bit. I'm not going
to go longer, but
yeah.
how would this work for? Sorry, how would this work with respect to non-cash? You know, in this interest rate environment is one thing, but for many institutional, they won't put up cash. And to think you can get, I mean, it won't work, just to be clear. What you're proposing can't be done.
Okay.
You can't get real-time information.
Well, we will
on non-cash, and so.
What do you propose? What do you suggest for confirmation?
Longer discussion, but I'm just saying that
okay.
I don't want to break the commissioner's rhythm on this, but sorry.
Well, we're totally open to. I mean, that's this committee and we will have a rule package that'll be proposed, and we will be looking for comments and suggestions. I mean, I think it's in everybody's interest to find ways to enhance every element of this, and so we're totally open to it. So if it doesn't work, great to know it, and if there are better ways, then it's great to hear that as well, and we will run down any options that we can, and we will we'll take all things into account. So
do you have a sense of how many banks, custodial arrangements there are? Where is the money today, and who will we have to build out this network to? What is the extent of this reporting that we'll need? Yeah,
and obviously our examinations folks, Kevin Piccoli and so on, can give you much greater detail. But some of these, and your folks around the table, I mean, but the number of accounts and can be very, very significant. The locations, custodial accounts, and the number of bank accounts can be very large. I couldn't give you a number off the top of my head without checking back with our folks, but it's a very large number.
Keep the presentations going. Thank you, Gary. Chris Haymeyer.
Thank you, sir.
Thank you very much, Mr. Chairman. I do come here today wearing a couple of hats, but mostly with my hat on as chairman of the board of the NFA. And a little bit that's what has been said so far. I'd like to put that a little bit into some perspective, which I think NFA and from my chair we can do. Yes, I also have an affiliation. I'm a non-executive vice chairman with what is now Knight and was Penson. So I also would like to say that in addition to the trading, I also have an appreciation for the complexities for the FCMs. Having said that, I would like to say that what smoked out the fraud at Peregrine in this instance was NFA's use of an e-confirmation process, and Chris Shellhorn from Capital Confirmation LLC is here and can describe that. And that was in our annual audit of Peregrine, where we were moving towards an e-confirmation of what bank balances were. And that's a relatively simple thing. It's an e-confirmation just of a bank balance. And we are going to make it now that to be any acceptable bank depository that they have to have this e-confirmation ability. But there are banks out there that don't have that are perfectly good seg locations, but we're working on a rule with the CME and with the CFTC, and that takes some technical legal work to require banks to have e-confirmation for auditing purposes. Ultimately, where we want to take the e-confirm process is a daily basis of collecting the seg information that NFA collects from all of its FCMs today and now on a daily basis, clearing FCMs and non-clearing FCMs. We want to get to a place where, and the technology is there, and this is feasible, where we collect the information from the FCMs about their seg and then confirm that online. And I think that that's exactly what Gary's talking about. But Cliff raises a very good point in that FCMs are able to put segregated funds by law, and certainly able to do it, and they do it every day, in different types of depositories. Banks are pretty easy. Broker-dealers are maybe a little bit tougher, but when we start getting into certain FCMs putting their deposits into term repos or foreign government debt or 30.7 or in other time zones, and FCMs are good seg locations to each other, it starts to get complicated. And I want to come back to that, but this idea of what at NFA we call the big system, but it's basically a depository of segregated funds confirmation system is what it is, a daily segregated confirmation system, so that we get the report from the FCMs daily as to where they have the segregated funds, and then online we confirm those balances with the depositories. But that's a big, complicated, hairy project to do. And so let me come back to that for just a sec, because in the interim, and that's going from just an e-confirm at an audit to a big, hairy system that does all of this online. In the interim, what we're talking about is a direct view online access, which is really, Commissioner O'Malley, what you're talking about is going online and checking a balance every day. So if we've got, we can spot check, and yes, we're talking about, I think, 3 to 6 people that would do nothing but in the mornings go online, check balances, manual process, takes a lot of time. You got to have people involved in all of that and have some idea of what they're looking for. And so the interim would be this online process. And we were in the middle of working on this online process before Peregrine as a result of MF. And some of those online processes are not going to prevent what happened at MF, because if there are thousands of transactions moving back and forth, it can be very difficult to online go on and check a balance. But it would have caught the Peregrine thing. So we are working, NFA is working, and we've got a very good special committee of our outside directors that was looking for the protection of customer segregated funds, that works with CME, which is the other DSRO. But we, and actually this is the SRO committee. We have a very good SRO committee that's been working on this project and understand the issues. And this online requirement of requiring the bank depositories to have online access, we hope to approve that at our August board meeting. That'll be coming to the CFTC. And again, this interim step of online manual checking bank depositories is a very good place to start. But it will be online, but it's manual. So those doable, in our control things we're going to do quickly with CFTC and CME and other SROs the other exchanges and such. So let's talk for a minute about the big system, if you will, if we call it that. So, basically what we're talking about is taking the online system or the e-confirm system, and making it a daily collection of this data. And this is possible because we have the FCMs today, clearing and non-clearing, sending their daily seg data to NFA every day. So what we want to be able to do is to have that information come in electronically and then confirm it electronically, and that's where it gets complex. It's pretty easy with a bank. It's the other time zones, 30.7, the complexities of that, which will take some time. And I don't honestly think, as from my chair, that this is a judgment call, but I'm not sure if the political will was there to spend the money and scope out this kind of a project at NFA and do this before the Peregrine thing. But and the people I've talked to, without officially taking a vote or something, I feel that the will, and especially now that we've all focused on this, I think the will is there, and I'm sure it is, and I think it's going to take some work to try to scope out the scale of this project and decide what we can do first, get it into Gantt charts, how long that would take, what we can do, what we can't do, some business requirements, and work with, of course, with the CME. Now, you're going to hear a lot of things today about different solutions. A custodian third-party solution, a custodian at an exchange solution. Those are bigger discussions, and I'm, of course, here to discuss possible other comprehensive solutions. But the technologies at NFA, and we have a couple of technology things today, that trade practices and market surveillance, I think it's called TPMS, We can leverage some of those technologies. We have this information coming into the organization today and the online confirmation, and then you can check with online confirmation for exceptions, patterns, things like that. And so NFA, I feel, has got this within our capabilities. Certainly, it's doable. It is affordable for the industry. I think we can do this. It's going to take us a lot of work, and we hope to try to have the scope of this laid out by our August board meeting. It doesn't necessarily change some of these other ideas that are going to come up, but it can address getting information from FCMs daily and confirming as much as possible balances at other good seg locations. Let me see. Give me one sec here to get caught up with my notes to see exactly where we are. Again, I'd like to emphasize here that the tricky part will be working with the depositories, because they come in different sizes and shapes, money markets. Frankly, we'd have to get the clearinghouses to agree. But for our members, I think that NFA has a very good position to be able to, the members are going to be required to send us the seg every morning, and we can then confirm it. I would like to also point out one other thing. And again, in trying to distinguish between e-confirm, online manual, and a big system that does this in an automated way, those distinctions can get lost in the wash a little bit in some of these types of discussions. I also would like to point out the distinctions between real time. Real time's not going to be yet. Real time is during the day, and the exchanges, of course, do that with positions, pre-trade, for instance, and then immediate with all of the positions in the risk systems. That's a little different than the reporting for the FCMs of this seg stuff. That for the most part, because of out trades and such, doesn't get prepared until the next day. So really what we're talking about is batch once a day at NFA, this system we're talking about, as opposed to real time where we're monitoring, because I think you'll hear from some of the FCMs who are here today, they have thousands of electronic transactions every day, and NFA is not capable, certainly now, of monitoring all of those electronic transactions in and out of seg funds and the FCM's depositories during the day online. That would be, very expensive, maybe some way down the road. But this batch of basically it's T+1 the next day, which all the FCMs are preparing seg statements the next day, and a confirmation of those deposits is something that's within our grasp.
Great, thank you. I think you've pointed out several good points about what NFA is doing today, what will take longer to complete, the challenge of it, and integrating all of these pieces. I think it's important to realize that what we have here in these two recent meltdowns of the FCMs are two completely different scenarios, and we're trying to put together solutions that kind of solve for both. MF Global money was massive amounts of money was moving at the click of a mouse all over the place, and therefore, obviously, the response is a real-time response. We want to see where this money is going, because based on what happened there, massive amounts of money were in and out on a daily basis, and we have to solve for that. That was in terms of dollar amount, a much larger amount. In regard to Peregrine, it's a long time consistent theft or fraud of customer money that must be addressed in dealing. Obviously, we're past the days of the whiteout and everything else, and moving to an electronic system will solve that. But we have to think about all scenarios, how we're going to fix them, and how we're going to solve for them. Another point you brought up that I think was interesting that was not addressed in Gary Barnett's comments. And Gary, I'd like to maybe if you could fill in the gap on this one. What are you thinking about in terms of an electronic system for 30.7 money? This is obviously foreign futures money, U.S. customers trading on foreign boards of trade, trading through an FCM here, but their dollars are somewhere else. What level of protection can we offer or tie to enhance the customer protection in that scenario?
All we are thinking at this point is the same thing with respect to the secured funds that are under the control of the FCM.
The domestic FCM.
Yeah. So if more than that is possible, then we should consider it. But so far the Part 30 system is not set up in that way. Well, we are talking about getting rid of the alternative method, but in terms of monitoring more, or validating or confirming that funds are, posted at as margin, let's say at a foreign exchange or something like that, we don't have any we haven't proposed anything in that regard.
Okay. And obviously, when we get to the FCMs, and Mike, that might be as a global FCM, that's something that you'd want to address, Jerry, you as well. We were going to go to Brian, CME. We'll check his flight status. Let's go to Jerry Corcoran, head of R.J. O'Brien.
Hey, Scott.
Yeah, Commissioner Chilton.
I won't be interrupting. I apologize for this thing, but I did want to mention, Chris, you did a really good job of describing, how it could work. And my only urging is that I know how these things go. You guys will meet in August, and you'll try to set up what you think should be the parameters. Then you'll meet again in November or December. And, I just urge you to keep urgency in your mind. That it sounds pretty complicated, doable, but it sounds like it could be something that, we wouldn't have done, like even next year, if we don't put the pedal to the metal. So I just urge you to, if things will be out of the headlines. When things are out of the headlines, there's not the urgency. And I'm just telling you, we need to do this. And so I commend you for everything you said and how you've gone about it, but I urge you and your members to move as fast as you can to put these systems in place and working with us. Thanks very much. I won't keep interrupting, Scott. Thank you for your patience.
We're pleased to have your comments at any point, so don't hesitate. I can't help but interrupt, so I would think it would be difficult for you as well. So, Jerry.
Thank you, Commissioner. I have a presentation I think is fairly pertinent to what we've been talking about today, some real-life examples of the challenges, some of the areas that are easier than others, and certainly some of the things that Cliff pointed out. So I'm just going to get started here. First of all, I'm not sure, the group here knows much about R.J. O'Brien, but we've been around a long, long time, since 1914. I think we're the oldest FCM in the industry today, founding member of the CME, and have joined many of these exchanges you see up there. We're the largest independent FCM, non-broker, broker-dealer FCM, and we're the 11th largest overall as measured by customer assets. We have $400 million of annual revenues, $4 billion of assets, including $3.6 billion of customer assets, and a capital base of over $200 million. I have a theme here. I took it from Reagan, trust but verify. And I think it's a new era for the futures industry that we're talking about here. And transparency is going to be awfully important to restore the safeguard, the confidence in the system. And so I think all FCMs that I know of and are participating in the collective voice of the industry have agreed and support 100% the ability for the regulators to have transparency into the balances, not only in our bank accounts, but in custodian accounts and exchange balances as well. Along with that transparency, there's other checks and balances that the industry has worked on very, very hard. The FIA has worked in conjunction with the Commission and the NFA to put together the NFA Financial Requirements Section 16, which becomes effective September 1st, which puts in a whole new level of protections for customers and transparency as well to the regulators. One of the points that I think is coming out as this process evolves is that, size matters. Now, what I mean about that is, as we continue to require FCMs to report on a daily basis, it just doesn't seem likely or possible that the small FCM can exist in the environment of the requirement of the separation of duties that are going to be required to mitigate risk. And so I think at some point the Commission will have to consider the size of an FCM and are they capable and have the financial resources to put in the internal controls on the separation of duties to conduct business the way we all are leaning towards. So I want to talk about the complexities of the asset verification process. This is a little technical, a little granular. My background is I am a CPA. I was a CFO at R.J. O'Brien for many, many years. I understand in great depth the segregation of customer assets, and I understand where they're placed. And so I'm going to walk you through here a segregation statement of R.J. O'Brien and look at the different seg locations that we have to verify. The bottom line of this is that this can all be done, but it's challenging. It's not necessarily real time in every instance, but it can definitely close the window on fraud by working on a T1 basis. So first of all, the segregated statement is made up of two components. The first component is the actual liabilities that we have to the customers. This is not where the assets are located. This is the assets that we hold on behalf of our customers. And in this case, on this seg statement, RJO was holding just short of $3.6 billion of customer assets. And you can see there in a number of different categories: cash, securities, the net unrealized gain or loss in the marketplace, option values, and some other accounting matters. I mean, this part of the balance of the seg statement hasn't been discussed too much, but it's important as well, because if a fraudulent FCM is understating liabilities, they can also understate their assets then as well. So we can't overlook the importance of making sure the regulators are certain that the seg requirements are accurate, because if they're understated, it allows a fraudulent FCM to conceal losses. So I'm going to walk through the seg statement here at R.J. O'Brien. You can see in the top right, I got a little green light. This is the areas that I think are really workable, that people have talked about. So this is, in our case, we've highlighted cash that we have at bank accounts. On this date, we had about $1 billion of customer cash. Okay, and if you look to the right of the screen, you'll see that our cash is located in 9 different banking relationships and 34 actual accounts. So these are the bank accounts that the regulators could have real-time access to. If there was something going on that they wanted to look into, they could see it at any time. In terms of tying it out to the seg statement, they'd really work on a T1 basis. What was the ending day balance, and did it compare well with the seg statement? Pretty easy. I think it's all doable. A lot of work. I shouldn't understate the work that is required to get it done from a technology standpoint, but the technology exists today, and it can be done. The next category is a little different. It's the securities representing investments of customer funds. This is different, and this is what I think Cliff was alluding to. These are held in RJO's case, 3 custodial accounts. They're containing permissible investments pursuant to CFTC Rule 1.25. There's not real-time access to this data necessarily. This is data that you would get on a T1 basis, end of day, at some point after the close of business. Most of the custodians post mark-to-market valuations pretty quickly these days. You don't have to wait to the next morning. So that's a green light as well, but it's not necessarily real-time. The next category are securities held for particular customers or option customers in lieu of cash, and these can be deposited in 3 different locations. They can be in bank accounts, they can be posted at the exchanges. In our case, they can be posted with other FCMs that clear other markets for us. So again, for us, it's comprised of customer-owned securities which reside at 3 counterparties, which are comprised of banks, custodial accounts, or exchanges. Again, this one's a yellow light because it's spread over a number of allowable seg locations, and the regulators would have a number of places to work with to tie out balances daily. You can also see at the bottom of the schedule, I've got a running total of how many accounts would need to be verified at R.J. O'Brien. So up to this point, we're at 40, and this is a yellow light item. The next schedule is cash at exchanges. So this contains exchange pledge cash and permissible investments of customer segregated funds. For RJO, it's at the CME and the ICE exchanges. I don't think we'll have any trouble with the exchanges providing real-time access to our accounts. In some cases, the exchanges, the DSRO, so they have access to that. So that won't be too difficult, and we're up to 42 accounts. Then you move into the actual settlement from clearing organizations. This is an asset or a liability depending on the OTE of the customer assets. This one is, we red light it a little bit because it's complicated. And it's complicated because there's reconciliation process that occurs in the back office on trades. Let me give you an example. The CME may say RJO has an $8 million asset we may say we have a $9 million asset. And what's the difference? Well, it's an out trade. We still have out trades. You could still have a problem where a trade didn't hit an account on a given basis, or whatever a back office process is. So actually for a regulator to tie it out, if it doesn't tie out, they're going to need access to the FCM's balancing statements, as we call it, the jargon in the industry. So they will have to have access to a balancing statement, and they'll have to understand the balancing statement to review it and ascertain that the balancing statement itself isn't fraudulent. So this gets a little more complicated. It's not as simple, and it would take some more work, and it probably isn't. The initial element of the verification could be automated, but there will absolutely have to be human intervention to review reconciliation process. And we're up to 44 accounts now. The next category is just the option value, long and short. That's pretty easily confirmed with the exchanges. You could do real time. Don't think it's really necessary. T1 is probably okay with in terms of monitoring and verification, and we're up to 47 accounts. We have our net liquidating equity. This is at other FCMs. In our case, we clear the Kansas City and Minneapolis markets through another FCM. That can be verified as well, up to 48 accounts. So, what's it going to take? Just for RGO, we have 48 accounts in the SEG domain. If you take into the secured accounts, 30.7 accounts, you're probably looking at 70 accounts with banks, clearing brokers, and exchanges. And I think if you try to extrapolate that to the industry, where there's 116 registered FCM, there's well over 1,000 accounts that would have to be verified daily, some of which can be done electronically and matched off with computers and technology. But more likely, there'll be periods in both banks and the clearing brokers and the reconciliations with the exchanges where there'll be a need for human review of reconciliations of balancing statements. So the bottom line here is that it can be done. It's going to take a lot of technology and integration to make it efficient, and I think that we shouldn't be in any way held back from doing this thing quickly. And it can be done by segments. Let's get the cash nailed down first. Then let's work with the exchanges on, OTE. I don't think we should wait for the big bang. In other words, let's not wait until everything's perfect. Let's start eliminating the risk as quickly as possible, and that, of course, is in play already with the independent verification of the daily bank statements. So that concludes my presentation. I hope you found it meaningful in light of what we're talking about today.
Well, it was extraordinarily helpful to understand and just walk through that balance sheet and give us some perspective about what's doable today and what will be a bigger challenge is very helpful, and I think it can help our staff really focus on addressing each of these pieces. Now, NFA is obviously, Chris, you mentioned in your remarks that having your members, NFA members, kind of respond to this. Jerry, you said let's not wait for a big bang. What can be done? How can the FCM solution move forward and not necessarily waiting for a comprehensive solution either from DSIO or NFA? How does this all come together? What's possible?
If I could, I think Jerry and I are saying in many ways exactly the same thing. I couldn't agree with Jerry any more that the places on that balance sheet, like bank depositories, that's pretty easy. So collecting the information that Jerry just presented and have an electronic system that can confirm some of the balances of those 1,000 accounts around the industry, and maybe it's a couple of hundred of the easy ones, we can get that done pretty fast. It's the more complicated deposits that, as Jerry just went through, that makes it more difficult, but that shouldn't hold us back. We can phase this in. It doesn't have to be big hairy monster all at once. It can definitely be a phased thing, and we can move pretty quickly to do that. Don't you agree, Jerry?
I agree, and I would say that most fraud takes place in the cash domain, and not necessarily within the trading element of the relationship with the CCPs. So if we can nail down cash, we've really closed one element of the window, but the typical element a fraudster plays in is in cash.
Jerry, I apologize because I was late at a dentist appointment, but
you said dentist, right?
Yeah, I would.
I thought you may have said tennis.
No, not tennis. No, not tennis. Dentist, and I much preferred to have been here. You said the cash could be done near term, and I didn't see the full presentation. Was the main other accounts those trading accounts with the CCPs, or is there a third bucket of accounts?
There's a third bucket of accounts, and that's customer assets that are invested in securities that would be held at custodial locations.
Okay, so you have the cash accounts, the custodial, and then the CCP.
That's pretty much the three big buckets.
Three big buckets. You think the cash side, we could get direct electronic for the NFA and CME and the other SROs pretty promptly?
Correct.
How long do you think it would take for the other two buckets?
Well, the custodian balances won't be difficult either. Those aren't real time necessarily. Those are T1. So those are end-of-day balances that you would get shortly after the close of business. But you also have to.
So two areas: the cash deposit accounts and the custodial accounts. I mean, there'll be work, but those are relatively
correct,
straightforward.
And then when you have the DSROs, and let's just use RJO as an example when we talk about the exchanges. If the CME is, which is our DSRO, is doing the verification of assets for RJO, they have, of course, the balances for our OTC at the firm. And they would have access to our balancing statements next day, roughly around the same time the SEG report is done. The point in that, Chairman, is that there's usually a reconciliation process involved. It's not necessarily a match off. Okay, RJO says 20 million, the CME says 20 million. It's done. There's differences, and I think there will probably be a statistical way to look at differences and say what has to be investigated and what doesn't. If we're within 99% or 98% of a match off, maybe it's not investigated on a daily basis. If it's 80% or 90%, then yes, I think there needs to be an element of human intervention to ascertain what's causing the difference.
And as your DSRO, they would have their balances at that clearinghouse, but they wouldn't necessarily have the balances at other clearinghouses.
Correct. So there'll have to be a cooperation amongst clearinghouses to provide data to the DSROs on a real-time or T1 basis.
And then for those that are members that are non-clearing FCMs would really just have the cash accounts and the custodial accounts.
Maybe. I agree with Jerry.
They would have omnibus accounts with
clearing
clearing
omnibus
firms.
accounts, and FCMs are good seg locations to each other, and that's where it probably gets to be complex because a smaller FCM may not have all this capability. But the big pieces, the banks and broker dealers, that are good seg locations, and clearinghouses. Clearinghouses and banks are the easiest. Broker dealers are next, then other FCMs, and then other depositories that are approved for seg. It gets to, and those are the smaller amounts of the total U.S. seg, but that's where the complexity comes in. The big pieces are fairly easy. I think we can do that fairly quickly. And how long to do that is we're going to work at NFA to try to figure that out.
And so as Gary Barnett, his folks finalize, I mean, they already have in front of us commissioners some rule text, but as they tweak it and finalize it, what I'm hearing is there may need to be a little bit specificity about cash balances, custodial balances, and those balances at clearinghouses, at least those three main buckets, that there may be a little different language in each, with the same goal that the self-regulatory organizations would have some direct access, or maybe not. I'm just trying to help Gary out here.
I think it's the category of custodian that probably gets complicated. The CCPs and the banks are relatively easy. The custodians, if you will, which are all good seg locations, come in different sizes and shapes.
Next, thank you, Jerry. Mike, go next.
Great. Good morning, Commissioner O'Malley. Also, good morning, Chairman Gensler and Commissioner Chilton and the TAC committee. My name's Mike Dawley. I look after Goldman Sachs's futures clearing business, and I'm also chairman of the Futures Industry Association. Also known as FIA, it predominantly represents the FCM community, but also has exchanges and clearinghouses and a host of other market participants from 20-plus countries as members. First off, I'd like to commend Commissioner O'Malley for leveraging the TAC committee to at least initially focus on this very important area related to customer asset protection. There's certainly a lot being focused on by regulators in the industry, post-MF and now Peregrine, but honing in on implementing data verification functionality is a critical step in assuring what I reference as a foundation of confidence. In other words, making sure that regulators and any information disseminated to the public reflects reality. As we know, both in the MF Global and Peregrine events, the information that auditors were looking at was either completely fictitious or wasn't providing a clear and complete picture of the firm's situation. We must assure we arm our regulators with the most robust tools as to weed out not only the evolving fraudsters, but also the sloppy and operationally deficient firms. So transparency is really the key here, and to the extent possible, I think FCMs, they just have to be able to provide regulators and our customers, in some respects, granular information on the amount of funds they're holding on behalf of clients and where those funds are located. As you know, the MF global bankruptcy started a lot of processes, one of which was FIA putting out some recommendations, and also FIA supporting the CME and NFA initiatives to require FCMs to report their segregation calculations required under CFTC rules on a daily basis and to twice monthly report investment of customer funds. With the Peregrine failure, that's probably not enough. So, I think one additional requirement we fully support is the SRO's decision to require FCMs to permit electronic confirmation of client segregated balances, as well as their proposal to permit regulators real-time view-only access to the FCM's customer bank and custodial accounts. So, which is really the topic of today. I think we can get into the weeds later as to how we might attack some of these challenges. I think we've kicked off well, and Jerry did a great job of pointing out how many accounts might be involved. I have no idea how many we have at our FCM, but I would expect it's something similar. But I do think it'll vary by firm. But look, we're anxious to work with the CFTC and the SROs to look at expanding this concept where possible and to assure, as I said before, that regulators have a clear and complete picture of a firm's status on as close to a real-time basis as possible. I think we're going to be challenged by being able to do too much real-time, but I think we should explore how far we can take this. Separately, FIA is actively considering how to construct and populate an FCM informational portal, if you will. In the spirit of transparency, we feel there could be value in allowing the public and regulators access to a portal which centrally houses public information and other material information about FCMs in order for customers to more thoroughly evaluate and understand their service provider. Technology is obviously critical in this effort and in assuring that regulators and customers get the right information. And we also look forward to working with the CFTC and SROs on that idea at this stage. But also as important as all these steps are, we can't lose sight of the fact that all this will be greatly diminished unless firms have strong internal controls. I don't want to lose focus of that. FIA recommended a whole host of things in February that represent best practices, and we believe most FCMs are already following those. Sadly, these internal control best practices weren't followed by the likes of Peregrine and MF, but we do think that's a really important precursor to, implementing an electronic solution. I'd also say as the committee and the CFTC move forward on these issues, I would encourage you to also take advantage of the FIA's Financial Management Committee. This committee is comprised of senior FCM, Treasury, and finance professionals, as well as representatives of various depositories. They've been meeting regularly since the MF Global bankruptcy, and were primarily responsible for preparing FI's recommendations for customer fund protection, which were released in February also. The members of this committee have an exceptional depth of knowledge and are willing to work with the SROs and the Commission to help implement an electronic confirmation program or any other improvements that assure that customer funds are protected. I'm not going to go on too much longer with these comments, but look, I'll be honest, I think the world's pretty surreal these days, and after 30 plus years in the futures industry, I never would have expected that the stars would have lined up like they have over the last 9 months. Having witnessed a long list of major events that in some form affected the futures industry, going back to the Hunt Brothers silver squeeze, or the Barings event, or the crash of '87, several events in the 90s, including the Niederhofer losses that converted into the Refco fraud, all the way up through the Lehman Brothers bankruptcy. I just think none of these seem to compare to the back-to-back events of MF Global and Peregrine. The damage they've done is just it's just awful. I think we really need to feel for those who lost money directly in these two situations, but it's important to note that we're all victims here. The trickle-down effect is devastating, and I couldn't begin to put a dollar amount on the on what this has cost. I mean, between resource spending and a loss of business, loss of productivity, I expect it to be a far greater number than what was misappropriated by MF and Mr. Wassendorf. So we owe those who were directly violated, and we owe ourselves to quickly, to Jerry's point, identify specific deliverables that will restore confidence and assure compliance with the rules and the law. With that said, I look forward to today's discussion. I'm going to be happy to answer questions, and quite honestly, I am confident that, and this has been the case for decades, that this industry will direct all of its passion and pride towards a solution that will be meaningful and hopefully enhance and bring back client confidence. So those are my remarks. I think, a couple comments based on what I've heard out of Chris and Jerry. I think, I agree with everything Jerry said. I think his presentation was great. The seg calculation that he put up on the board is like such an important process for all of us. And to delve into that and understand it is going to be really important for regulators. I don't know how many auditors would really have appreciated that there's all these different locations on that one piece of paper that really need to be delved into. So I think, I really think it's important for the regulators to be fully informed and educated on this process before we enter into any sort of a technology build, because there are complications. We have to determine, okay, what do we want to report, in what form, when do we want to do it, what time of day, and there's a whole host of other things that I think we would need to standardize across custodians and clearinghouses and FCMs and banks. So I'll stop there, Commissioner.
Thank you very much. Can I suspect, beginning with MF and heightened by Peregrine, that your customers are calling and they're saying, "Where's my money? Why can't?" Or what are your? And rather than me guessing at what they're saying. What are they asking you to do? What changes are I assume we're roughly on the same page, but are they asking for anything different than what we're considering today?
It's been an interesting several years. I'll say this, and it really goes back to Lehman. The events of Lehman's bankruptcy forced a whole wave of questions, and it involved an educational process with clients to understand how bankruptcy works and how the law is different in the UK versus the US. MF was a whole nother problem, which involved internal controls. And when clients asked whether something like that could happen at our firm, it really involved having to educate clients about what goes on internally at your firm. How are the seg calcs done? Who does them? Are there proper separations of duties? What's the oversight? Who audits those sorts of things? And then you have Peregrine enter the scene, which is outright theft. And, that's a different conversation. So Lehman, MF, Peregrine, all terrible, challenging events, but all very different also. And, the calls do keep coming in. We're continually, and this is to my point where I say the cost to the industry and the trickle-down effect is enormous. The FCMs are spending the majority of their time dealing with this issue. I spend 70% of my time on dealing with these issues as an FCM head, and it's it's very unfortunate that these two organizations have caused this. But I do think that there's a lot of really good enhancements we can make. We're already heading down that path, and I think, Scott, your ideas here and what you're focused on is really the core of all of it. It's really that verification process that makes everything else kind of work better, and so I couldn't be more supportive of implementing something like this, and I think that's what we really should work together on. We need to get into the details. We need to sequence it properly. I agree. I think we start with the banks. That's kind of low-hanging fruit in my view, and get those done, and then move on to custodians, and then figure out how we're going to handle the global environment, which really gets challenging. Just to give you an example, what my seg calc might look like. I have one line item on there that says GS International, our UK affiliate, which is in essence the window into the rest of the world.
Right. Well, that was my next question. Yeah. When I asked Gary Barnett what is his plan for the Part 30 funds, these are still U.S. customers seeking exposure overseas. Money starts with an FCM in the U.S. It's placed overseas. How do we protect them? And what's the technology solution there?
Yeah, I mean, look, this is where you're going to have affiliates verifying balances, right? But we all know that those balances end up being passed through to Singapore and Korea and Tokyo and Spain and Germany. So, that's to my earlier point also. How far do we want to take this initially? I think this should be an evolving effort. I actually agree that the more transparency we provide, the better. It's just a question of how are we going to do it efficiently and assure that the data is actually meaningful and useful, not only to regulators, but also to clients. And, we're committed at FIA to work with the Commission and the SROs on this, but I'm not going to deny the fact that it's a big lift to really make this work on a global basis.
Mike, I thought your words were very apt, poignant. I mean, that these various events, and maybe going back to Lehman, as you say, highlight how important it is to rebuild some confidence. A system that's worked well for decades gets challenged by new fraudsters in the case of Wassendorf, or new operational failures, and as you said, so some of these have different varieties. So I'm encouraged. I think we've done a lot working with the market. I mean, these various initiatives that the NFA just finalized, and we worked with you all in the NFA on I think are strong, but my first question is going to be, what are clients saying? Of these initiatives that we just put in place, closing what I would call the hole in the Part 30 account that all FCMs now have to do net liquidation rather than alternative, saying that excess, to tip your hand into the excess house money that's in the SEG account, you have to have senior management sign off if it's more than 25%,
Yep.
and the daily reporting and the other key reporting information. What are you hearing from people on this package that isn't enough, but was a significant package we all put together in the last 6 months?
I think, that's a great question, and I think the enhancements are really, really meaningful. Now, do clients appreciate them yet? Probably not. They're rattled, and they should be. It's really up to us as FCMs and the regulators to continue to educate clients as to how this process is going to work and why these enhancements are so meaningful. It was quite interesting, to really learn, especially post-Lehman, how little the buy side really knew about how FCMs operate on a daily basis. So, it's been, and I welcome this. Our firm is very, very supportive of clients being as educated as possible. And I think it's just going to take more of that, Gary. I think we just have to make sure that we make our clients aware of how the system works, where their risks lie. Are we going to be able to mitigate every single risk? Probably not, but as long as clients are comfortable and appreciate where the risk might lie, we're better off.
So, I mean, we're looking to take that package that we worked together on at the NFA and put that in, our federal rule book as well.
Yep.
So to the extent, I mean, we're hopefully going to do that in the very near term, put it out to public comment, even though it's already in the NFA rule book.
The sooner the better, as far as I'm concerned. We support the NFA 16 fully, and I think it's important to get that thing implemented.
At the federal level as well.
Sure, yeah. I think the NFA goes when, Chris? September 1st or?
I'm not sure, but I think something like that.
Yeah, I think that's right. I mean, it will be, just for the media, it will be implemented when NFA does it, but we want to put it in our rule book as well.
Yep.
The second piece of it, which is this direct access to custodial bank accounts and the clearing accounts, I'm hearing some, growing consensus. There's a lot of details to work out, but growing consensus. We're going to try to put that out to public comment as well. But it might be that NFA is going to be doing something even at their August board meeting, as I understand, which is encouraging. But I had a question in that regard, just on the details. You talked about all the international accounts. Was that in this SEG account or in the secured? So is it Part 30, or is it? I'm just trying to.
Both accounts involve client assets, so how you actually structure an ability.
No, my question was following. Or in the segregated account, do you also have the affiliates in Korea and Singapore and London involved in that, or was that a reference just to the Part 30?
The Part 30.
All right, so Part 30.
My point was really that in order for FCMs to operate efficiently, there is a structure of utilizing affiliates as good seg locations, in addition to just using other FCMs for good seg locations, which came out of Jerry's.
But if we were either phasing or being nuanced to say that the direct electronic access for the SEG accounts might precede some of what goes on internationally in the Part 30, is that what you're trying to highlight, or are you saying both have an international component?
As far as sequencing, I think we start with the SEG balances. I view that as lower hanging fruit that we can get sorted much quicker than grappling with some of the complexities that are going to involve the global.
On the international.
Yeah, exactly.
Jared, do you want to comment on where any Part 30 money was in that balance sheet you showed?
There wasn't any in that balance sheet. That was just the SEG report. I chose not to do the secured point 30 just because of time.
And I'm just going to use this opportunity. Beyond those two buckets, the putting in our rule book what we worked with NFA on and this direct access piece, the other two pieces, or at least two other pieces, is transparency, that investors have more transparency. And I think, Mike, you were talking about that through your portal, but we're also considering whether we should incorporate in some rules some greater investor transparency. And then the other piece is the internal controls piece, which we've all been talking about, but separations of duties and so forth.
Right.
When we look back to our rule books, from a lot of this goes back to the 1970s and 80s and so forth. They're frankly, they're very limited words that the intent might have been there for separation of duty, and the intent might have been there for good auditing standards, but we think that it's appropriate to put more words on the page about these internal controls.
I would agree with you, Mr. Chairman. I think that is a big part of what needs to be. Everybody needs to be comfortable with the internal controls that exist out there, and that there's checks and balances around them. So I think the best practices that we've put out can be expanded on, and we'll continue to work with you and the SROs to assure that those are fine-tuned. And you know, I just think that's important. And as far as the informational kind of portal idea, we have been working with Gary Barnett and bouncing ideas off of him. I think, you know, I don't think we necessarily care who does something. It's just like we see value in it. So FIA, for example, could create this portal. It could be a regulator that, or an SRO that creates it. I think the same holds true for this verification process, where we're seeing that NFA is doing this, but, you know, should there be a central you know, newly created entity that kind of houses this function? I don't know where it needs to belong. It feels like a regulatory oversight, you know, exercise. So, but I do think we should think about where it should sit and who should build it and maintain, you know, especially as we look to automate it and make it a much more efficient process versus the initial days where we'll probably still be using passwords to log in and identify balances. That's just not going to work long term. We need to figure out how to get data files sent to some sort of a system that still needs to be built. And maybe that's one of the panelists here today, one of the vendor solutions could potentially provide that sort of a service.
Well, that's certainly something we need to move to and discuss that. And I will, as much as we've talked about new rules and proposals and ideas to impose on the industry, we need to be reflecting on our capacity in the Commission of our technological capacity to integrate all of this stuff. And we need to make it a priority and talk about it in very specific terms and lay out a plan as to how we're going to tackle this, so you know, we can be have the appropriate regulatory response to all of this as well. We're going to go to Brian Durkin. Yeah, Commissioner Chilton.
Yeah, and you know, Gary, the chairman, asked a couple of questions that were a little bit off technology, so I'm going to go there just this one time. I promise I won't do it again. And thanks, Mike, for your leadership. I know it's been a tough time for the industry as well. And I do commend, you know, the Financial Management Committee, who came up with these recommendations very early on, and a lot of them were really good. But I do want to press you on two different things. One, in June, I'd called for full segregation, full-on segregation, where customers could choose whether or not their money went directly to some trust, either a clearinghouse or some other entity. You know, the FCMs would be allowed to charge more if a customer chose to not have their money be used for anything other than their trades and their margins. But I'm curious about your thoughts on that, and then I have one other question after you answer that one.
Sure, Commissioner Chilton. Look, I agree with you. I think what's come out of some of these events has been this this concern and this demand for some sort of a segregation regime that involves individual seg, as it's referred to. And I think at FIA and as an FCM and as Goldman Sachs, we've been very supportive in wanting to get into the detail around how such a system may work. And I think, as you know, Commissioner, there's been a group that's been put together, a segregation working group that hasn't met in a bit, but I'm about to reunite the band here again shortly, but that has talked about all these different models, including full seg and LSOC, and I think it's still a work in progress, and I think people are still exploring ways to provide choice to customers and trying to evaluate what the cost may be. We might get there. It is complex. There are a lot of bankruptcy-related issues that are involved, and funding challenges, but we're still working on it.
Now, they do allow full seg in the EU, if I'm not mistaken. And how do you guys deal with it over there?
Yeah, it's a little different. It does involve funding, but I think as far as how the liens work and that sort of thing, it's different than how U.S. bankruptcy law works today. So we've had a lot of discussions with Bob Wasserman, and we've had a lot of very intelligent bankruptcy attorneys and a whole host of other folks delving into the weeds on this to try and figure out a solution that can work in the U.S. So we'll keep you posted on that.
Thank you. I mean, in general, when we do something, I think it's good for the EU to look at it for their benefit, good or bad or ugly. And I think the same thing with regard to the EU's seg model is that we should look at what might be working over there. And then the second thing, and again, Scott, I won't go off technology topic after this, but is this issue of an insurance fund, Mike. And I mentioned it in my opening comments that the reaction I've received so far as well is expensive. But the conversation can't just end there. I understand it would cost money, but I also understand that they do this in a bunch of countries. Some in the EU and South Africa and Australia. Somebody told me, I don't know if it was Brazil. I think it's Brazil, maybe Argentina. So it's not like there can't be smart people can't figure out a way around this. It just seems unfair to me that security customers are protected, that banking customers are protected, and futures customers aren't. So if it's so expensive, then maybe there's a premium, or maybe they're not protected to the extent that the FDIC or SIPC cover people. But to just say it's expensive and leave the issue seems negligent to me. So I guess, one, I'm interested in your comments, and two, whether or not your financial management committee, maybe this is something they should look at.
Sure. First of all, I don't know who said it's too expensive. I hope you're not saying it was me.
Terry Duffy said it.
Oh, okay. Look, I don't know if it's too expensive or not. My view on insurance is that it hasn't been analyzed enough. And one thing I'll just share with you, one thing I brought up at I think it might have been an FIA board meeting or execcom was maybe we should look into insurance. Maybe we should have somebody like the IFM, which is a not-for-profit who's got funding, pay for a study and hire the right people to kind of piece together some ideas around an insurance fund that might work. I don't know if it'll work or not. I just don't have enough information, but I do agree with you that I think it makes sense to study it. And if qualified people come back and say, here's what it costs and it looks expensive, at least we'll know that it is truly expensive. I think the other complications that come out of an insurance fund is who pays for it and who does it cover.
Yeah.
I just think we have to be careful there so we're not lowering the bar and providing coverage for organizations that might not be up to snuff, knowing that they have this backstop. So I'm supportive of looking into it. I just don't know whether or not it's feasible and it can work in an efficient and effective way yet. But I will move forward with trying to get an analysis done.
Great. Thank you, and thanks for your patience on non-technology stuff, and thanks for your leadership, Mike. I'll be quiet for a while, Scott. Thank you.
Thank you, Commissioner Chilton. Brian Durkin.
Thank you, Commissioner Amalia, and distinguished panelists on a topic that has impacted this industry beyond belief since the MF Global and PFG situations. We've all collectively, the SROs, the CFTC, the NFA, the FCM community, particularly our work with the FIA and the NFA and the working groups attended to these initiatives, have all been deeply focused on one goal. And that goal is restoring the confidence in all aspects of our industry, of our customers, by ensuring that from these deeply appalling events, that our industry and the confidence in our industry brings itself back to a level of confidence that we have all collectively worked for, some of us, for decades to achieve. We need our customers to have that confidence restored. Now, through these two recent incidents, although it appears that the firms may be at fault, this is a problem that we all have to work towards resolution as an industry. We have to regain that trust, and every link of the chain must be as strong as the next. And so, Commissioner Amalia, we commend you for initiating this day today to make this more of a technology focus, because I'm hoping to be able to show to you that even through these very unfortunate events, we are a very resilient industry. We can rise above challenges, and we've taken initiatives and we've made strides in these last several months towards that end. We've learned a few lessons from what we felt was an impenetrable operation in terms of what we have collectively put together as an industry. We've added some enhancements to our overall reporting requirements, our rules and regulations, and everything that we have done to this date is really designed to enhance customer protection and to reinstill and reconfirm that confidence in these tremendous markets that we represent. What I am attempting to focus on today and how we've been utilizing the tools, the policies, and the rules that we've put in place is to further augment what we view to be very strong self-regulatory processes and programs that have been in place and have been the compilation of the ingenuity and the integrity of many around this room, of the Joint Audit Committee, and the efforts of the leadership of these fine organizations. At the hub of all of this is enhancing the strength of the programs that we have in place from our auditing and our risk management capabilities as SROs, augmenting it through the introduction of technology-based solutions that enhance the information that is at our disposal to be able to identify on a more timely basis any issues that may raise some concern or alerts us to concerns that we can go into the field and take immediate action based upon that information. We've made some great progress with respect to the confirmation of information that can be provided to the SROs. And although I missed Chris's presentation, and I apologize for that, I'm sure that he's alluded to and has represented what we together as SROs are working towards to provide near real-time confirmations in the context of what is maintained at the firm's depositories. But to take a little step in terms of what we are doing with the information that we have at our disposal, we are in the context of our yearly risk-based examinations that our audit teams performs through the incorporation of the additional data that we have received in the context of the requirements for electronic confirmations, as well as the daily reporting of segregated information from all of our firms. That information is incorporated in the context of our field work that we conduct as part of our audit testing. That information is utilized as we speak in the context of further reconcilement and validation of the information that has been provided and reported to us by the firms. The information is very valuable to us in the context of our daily monitoring and the systems that we have in place for conducting that daily monitoring. Separate and apart from the more detailed annual risk-based examinations that our audit team performs, we are also incorporating that information in the context of our limited scope reviews and our spot checks that we have undertaken. We've instituted an increase in the number of spot checks, and you may recall this since December of last year. And as we incorporate the information that is being reported to us both in the context of segregated information that comes our way daily, as well as the investment of segregated assets, all of those items are very important to us in the context of serving for further validation and tie-in of the information that we receive and that has been reported to us from the clearing firms. The electronic confirmation aspect is going to be very key to us in the context of third-party validation of the information that is reported by the third parties, and primarily confirming the bank balances through the third-party depository. Having access to this system provides us even greater confidence in the context of the security information, obtaining that information.
Brian, can you just ask one question? When did the CME group start to use this, well, you call it Capital Confirmation, Inc., but the electronic confirmations?
Relatively recently. Ann Fagan? Yeah, just in the last 3 or 4 weeks.
So since these events have transpired? Yes. Okay.
And in incorporating this information, we feel very strongly about making this a requirement in the context of performing our field audits. There's a third part of this in the context of working with other DCOs and ensuring that we are able to provide similar confirmations from the other DCOs that have mutual common clearing member firms, and we were working towards ensuring a process and a mechanism in place so that we're able to cover those relationships. Effective May 1st of 2012, we required all FCM clearing members to submit customer segregated daily statements electronically to the CME. And we've incorporated those reports in the context of our internal surveillance and our monitoring. How we go about doing that is in the context of reviews that we have developed through our automated monitoring of financial statements and financial reporting from the firms, we have incorporated certain alerts and tolerance levels in the context of now further incorporating this information as a further validation and reconcilement of what we have, on record in comparison to month-end segregation reports and doing a corresponding reconcilement with what's being submitted to us daily. We're also very much supportive, and I know that that's been spoken to earlier by a number of our panelists and colleagues here today, of requiring the FCMs to provide direct read-only online access to the depository information. Again, having access to that information, to state the obvious, provides additional validation and confirmation of the accuracy of the segregated information that is being reported to us by our firms. Effective July 16th, we initiated a limited review in the context of the requirements that were put in place for the reporting of investment reports. So semi-monthly, our firms are required to submit to us semi-monthly reports, investments reflecting the customer segregated funds, where those funds are invested, the dates that those funds were invested, who are the depositories of those funds, and the instruments that those funds have been invested in. And receiving that information twice monthly, again, that is incorporated in our risk-based reviews, and it provides us with more real-time information in the context of validating what has been reported to us by the firms, and it certainly is an added tool for us in the context of our full scope audits. CME is currently using the confirmation.com to perform its reviews of the FCM clearing members, particularly in the context of our review of customer segregation statements. We are incorporating this information in the context of conducting surprise audits of our firms. And what we are looking for is any material differences in the context of our risk-based examinations of all of our firms that we're responsible for. We will certainly incorporate this information as more requirements evolve out of the work that has been done with the SRO committee, as well as our interactions and coordination with the FIA and the CFTC. We're fully prepared to further augment the data and the reporting of this information into the context of reinforcing our very strong self-regulatory programs.
Thank you very much. We're going to go with Alan, Chris, and then Steve.
Thank you very much, Commissioner. Don't know if we can get the presentation going. Thank you, and thank you to the committee for giving me the opportunity to come and thank you to the committee and the Commissioner Chairman for giving us the opportunity to come and talk about how we may be able to see what's possible from a technology perspective when we address this area. Just want to spend a moment to talk about SunGard. We are a technology financial services firm. We are a global firm, and we provide services in the post-trade area certainly in listed derivatives, but also in securities, banking, and reconciliation. So a number of the areas that we're looking at are things that we have got experience with. I think when we look at what's been said so far on customer protection, I think particularly with the comments from Jerry Corcoran, very instructive as to how this is happening. I think a lot of the emphasis that's been put on so far has been around making a lot of this activity more visible and more auditable. I think that that's a very good thing to be able to have verification. But there is a manual element involved in doing that. And I think to the point that Chris was making, there are maybe two steps here. I think there is, firstly, the ability to go in and view what's going on, but that can be a fairly manual process. What we really, I think, need to move towards is what you would call the big system that gives us the ability to independently verify what is going on in this customer protection situation. So when I'm looking at things, I'm looking at what would be required to build that big system and what are the technology components that are in place there. So I see 4 elements to customer protection. The first one, again, was really brought out by Jerry, is to verify the actual client liability. So the FCM has got a view as to what the funds are that have been deposited with them, but that funds needs to be moved into the segregated asset accounts. Then there is the client liability as we see it from the DCO side. They are holding the positions. They know what the margin requirements are. And finally, the depositories who are holding those segregated assets. So we've got the liability as it's viewed from the FCM, who has got the client position, and by the DCO, who has got the FCM position. And then we've got the asset, again, from the FCM, who has got the client funds, and from the depository, who has got the FCM funds. And in order to independently replicate and verify the segregation calculation, we need to look at these 4 elements. I think one point to make is that a lot of this work is being done today. A lot of it is being automated on a daily basis. Again, going back to Chris's point, very little is done real time today. Most of it is done in a batch system. But most of these different reconciliations are being done within firms, within financial institutions. There is just no visibility to that process for either the SRO or for the regulator, and that's what I'm going to focus on. So in the current situation, you get the reconciliation between the FCM and the DCO. This can be very complex. Jerry mentioned the idea of all the out trades that can be coming in. We're looking here not just at reconciliation of cash, but reconciliation of trading positions, which obviously tie into that very closely. This is being done, however, by every firm with every DCO on a daily basis. And we're talking about the US, but obviously similar situations are occurring globally. So the foreign merchants, the foreign brokers are reconciling with their local clearinghouses and exchanges as well. The second piece is the reconciliation of the assets. In preparing the seg reports, the FCM are going to be looking at their bank statements. There is probably less happening electronically here today than people would like. Again, that will vary considerably from firm to firm and depending upon the capabilities of the different depositories as well. But those funds are being checked. The FCM, in preparing that statement, is looking at what they have on deposit and is able to do that reconciliation. They then are using those 2 pieces, the liability piece that has been reconciled with positions at the clearing organization and the asset piece that has been reconciled with the banks, custody banks, and with the DCOs. And from that, they put together the elements of the segregation calculation that Jerry showed very well in his presentation. The one piece that's not happening is any kind of independent reconciliation between what the liability is as it's stated at the DCO and what the assets are as they're happening in sitting in the depository. Everything at the moment is happening within the FCM. So I think the proposed customer protection model is to have that done centrally, whether it's by the CFTC themselves, by the NFA or the other SROs, or by some other body. And those 4 elements need to be provided in order to fully independently verify that the funds are properly protected. Then what you're going to have is a centrally reconciled view of the liability of the asset and a clear indication on each FCM as to the amount of cushion that they've got in their segregation, the ability to put up alerts and thresholds depending upon what it is that is felt necessary. All of those technology components exist today. These reconciliations are all happening on a daily basis. Some of them are happening on a real-time basis. All of them are happening at least on an end-of-day batch basis. What is not being done is they're not being done consistently using consistent formats. Some firms will be doing part of it manually. Some firms may have automated all of it. But there are different ways of getting the data from the different DCOs even, certainly different ways of getting data from the different depositories and from the foreign firms. So the complexity comes with trying to bring together things that are happening but are happening in a different way. And that's something where I think that the industry could help by setting standards. A lot of standards have already been set by FIX and by FPML and other institutions like that. So putting together some kind of standard and a requirement to conform would give us the ability to put all of this data into a central location and build the big system that Chris was talking about. And I don't believe that that big system is as huge as people are expecting. A lot of those components already exist, and it's simply a case of repurposing them to act as a central system rather than to act as an individual system for each bank. The only additional notes, a lot of this applies equally to the segregated and to the foreign secured protection. The complexity with the foreign secured comes with just the variety and number of different institutions that would have to provide this information. And as well, the point that Mike made, that in many cases these are affiliates who are providing on behalf of their counterparty in the US, and how far down the chain do you want to go with that relationship? Most of these report details, to reiterate, they're already in place. Some of them are being introduced as part of gross customer margin, and it's not a big change, I believe, for the industry to have these provided to a central location. Thank you.
Some of the challenges on this 30.7 though are how do you make that work? I mean, people pointed out, I mean, just by jurisdiction, you're going to have challenges.
You're certainly going to have jurisdictional challenges, and particularly as you go down the chain, it's very hard for somebody in the US to be able to enforce that without at least some kind of cooperation. I don't know how many depths of relationship people have got. Mike was saying that his UK entity is the view into the rest of the world. I don't know if the UK then goes to Singapore, which then goes to Hong Kong, which then goes to Korea. Tracing that all the way back is difficult from a legal perspective. Not from a system perspective. All of the data and the information is there, but I'm not sure how you'd be able to get that going all the way through from a jurisdictional.
Great. We did not have your presentation beforehand, so it's not in the packets, and nor is it on the website yet, which is the venue in which we're trying to provide all of the material. Both Alan and Jerry, do you have any objection to us putting your presentation on the website? You put some numbers in there.
We have some sensitive company data in there that let me talk to our general counsel first.
Fair enough.
Thank you.
Yeah, I have no objection.
But Jerry, it's sort of already in the public domain, I would note, because probably somebody was Twitter feeding it or something up there.
I'm just covering my butt.
Maybe you can check that box at lunch.
It's public information, so let me just check, but I'm certain it'll be okay.
Good. But you, Alan, you had no objection to
No
this?
objection.
All right, we'll circulate it, and we'll try to have his presentation put in your decks on your table here by the end of by lunchtime. Chris.
Chris, I suspect what's been bad for the futures industry has been all right for your business.
Well, it's been very busy, that's for sure. We certainly haven't been at a loss for things to do the last week or so. And my colleague, who's been on the speaking tour, is he's been the brain trust. So it's been interesting. But thank you, Chairman Gensler and Commissioner, for inviting us to speak. What I'd like to do is talk a little bit about the role that Confirmation.com played in uncovering the PFG Best fraud and how Confirmation.com can be used going forward to continue to protect investor funds and uncover or deter fraud. As background, Confirmation.com is the creator and patent holder for secure online audit confirmations. My colleague and the founder of Confirmation.com, Brian Fox, a CPA who worked for both Ernst & Young and PricewaterhouseCoopers in the early 90s, recognized that not only was the paper and fax process for audit confirmations inefficient, delivering confirmations back to the auditors 4 to 6 weeks after a request was made, he also recognized that the paper process could be easily manipulated by fraudsters looking to steal or misuse the cash from the businesses they ran and the cash provided by their investors. 12 years ago, Confirmation.com created the first secure online clearinghouse for audit confirmations, which now allows auditors to receive confirmation requests back in under 60 seconds and has been effective in uncovering multiple confirmation frauds, namely the PFG Best fraud, as well as others, including a U.S.-listed company fraud and many of the Chinese company-listed reverse mergers frauds. Each year, Confirmation.com processes more than $1 trillion in confirmation data, processing millions of confirmations from more than 10,000 regulatory bodies, external audit firms, and internal audit departments. With access to thousands of banks through our network, 70 of the top 100 banks respond to confirmations through Confirmation.com, to include 19 of the top 20 U.S. banks, as well as the U.S. Federal Reserve Bank, which launched our service last year. 25 banks, including such names as Bank of America, HSBC, Citizens Bank, BBT, SunTrust, have mandated the use of Confirmation.com and won't respond to confirmations sent to them any other way. Every top 100 accounting firm in the country sends confirmation requests through our service, and we're endorsed by the American Bankers Association, as well as being a preferred provider of electronic confirmations for the American Institute of CPAs. In fact, one note, 18 of the companies represented by attendees here today are users of our service as either requesters, responders, or clients. Confirmation fraud, by way of background, dates back 100 years to McKesson and Robbins fraud, which was the first recorded confirmation fraud. Within the last 10 years alone, we've seen more than 40 public company frauds involving mailed and faxed audit confirmations. Included are the 14-year Olympus fraud, which cost investors more than $4.5 billion in market cap value, and involved individuals at 3 different banks who intentionally responded falsely to audit confirmations. Parmalat, which fabricated a $4.9 billion bank account and concealed it for 10 years and cost investors 97% of their shareholder value in less than a week, along with many others such as Refco, Ahold, Kmart, and the majority of reverse Chinese merger frauds like Sinoforest and China Biotics. Our solution caught the PFG Best fraud, and if used even on a monthly basis, could have resulted in uncovering the MF Global situation. Ideally, though, the mandatory use of our service would significantly—
Chris, can I just ask, is that Revco the Revco that we sometimes talk about in the futures world?
Yes.
So it had confirmation fraud.
Yes.
Not around segregated accounts, but around bond confirms with the auditors? Is that what that's saying?
That's correct.
Okay, thank you.
Confirmation fraud happens one of two ways. The fraudster gets someone at a bank to intentionally respond to the auditors with false confirmation information, which happened at Olympus, where individuals at 3 different banks intentionally provided false and misleading information to auditors, or the fraudster controls the location where the confirmations are sent, making it look like the bank responded, which is what happened with both the PFG Best and Parmalat confirmation frauds. Most auditors today don't utilize the full capability of our service because most auditors still send confirmations just once a year. Confirmation.com's full capabilities have been used to provide confirmation responses in less than 60 seconds, and we have users who provide confirmation responses as frequently as 5 times per day through electronic interfaces. We have long been advocates for sending confirmations more than just 1 time per year because doing so can be a significant deterrent to fraud, and at the very least reduce the time frame that fraud could occur, thereby potentially limiting investor losses. Our service is a cloud-based solution where both the requester and responder can self-register, begin to use the service almost immediately with no hardware or software to install or maintain. Because most banks don't prioritize audit confirmation responses until perhaps today, we provide 3 levels of solution to banks. The first level has the ability to push or request data from banks who have not registered with our service. The second level, registered banks to literally begin using the service the day they register until they are able to allocate the IT resources necessary to tie into the Confirmation.com platform. And the third level, which is a secure FTP for automated confirmation responses. This third level integrates with banks' legacy systems, allows the banks to electronically provide confirmation response data through Confirmation.com to auditors. And we've documented a data communication standard for confirmations based on the work that we've done with some of our partners. While many people in the room would assume that each person working for a public accounting firm, internal audit department, or outside regulator has honest intentions because of their fiduciary role to the public, what probably isn't a surprise to others is that with hundreds of thousands of individuals having used our service over the last 12 years, we have had attempts where those with fiduciary role tried to take advantage of the technology to gain unauthorized access to private financial data. One can only guess at their motives: curiosity, accident, knowledge for personal reasons. But access to private financial information must come with certain controls to mitigate unauthorized access. With these controls, most banks' legal counsels won't allow for the release of private financial information. This is primarily because, absent such approval, the bank would have no way to determine that the auditor is making a request on an entity which is actually under the auditor's purview, where the auditor has the proper authorization to provide that private financial data. Without a mechanism for verifiable authorization from the bank's client to the bank, it would be easy for someone to gain unauthorized access to private data. To alleviate this concern for the banks, Confirmation.com's system provides a patented mechanism for proper authorization by the client to the banks for the release of the information based on the bank's internal legal requirements. This has allowed us to be successful in blocking unauthorized individuals from gaining access to private financial information. Based on the unique needs of the auditors, Confirmations.com's service can be configured to the 2 extremes, where in one case the client approval must be given on every request, or on the other extreme where a single initial approval is provided, allowing the auditor to send confirmations anytime, as often as the auditor would like, which is the option that we see is needed with the solution being discussed here today. While a balance and isolation won't identify fraud or the misuse of funds, Confirmation.com system can be enabled to automatically match confirmation response data to third-party data to ensure accuracy. This capability, in conjunction with parameters that can be set to trigger flags for auditors which identify anomalies occurring outside learned standard deviations, could indicate possible fraud or unusual account activity. What we certainly understand and recognize what's really needed is to restore investor confidence. Confirmation.com has been working on the solution you seek, we think, for the last decade, with millions of confirmations to identify multiple frauds as proof of success we've had. And the ultimate solution that the market desires is the one we've envisioned, the core of which is, we believe, built today and in use today. The solution we would propose is a cloud service that allows for transparency into the cash balances for both the auditors and investors as often as both parties require and is useful to them. That being near instantaneous, whether hourly, daily, monthly, quarterly, or annually. It allows for quick and simple use of integration by all parties, which will identify anomalies through both predetermined parameters and learned standard deviations, and provides usable reports for analysis by auditors and investors. With access to thousands of banks using our Level 1 solution and hundreds of banks, including 70 of the top 100 banks, the Federal Reserve, already using Confirmation.com's Level 2 service, and Level 3 solutions, along with more than 60,000 auditors, hundreds of thousands of audited companies, and with a solution that is also utilized by and beneficial to even the smallest of our community bank users. Confirmation.com's clearinghouse is an effective, cost-efficient service through which banks provide clarity and transparency into the cash positions of the companies being audited. I'd like to thank the committee again, the Commissioner, for allowing us to speak at this panel today. We've spent the past 12 years focused on catching fraudsters and eliminating confirmation fraud through the use of an efficient cloud-based technology. We're a proven system in place today, and we're prepared to work with whatever group to modify that to meet the needs of the CFTC.
Based on what our director of DSIO said, Gary Barnett, he said this 24/7, 365 view only. Can you provide that?
We could. I think the biggest need is the financial institutions that participate to feed that data to us on a regular basis.
I'm sorry for not knowing this answer, but what's the difference between what you're doing and something like SWIFT?
My understanding of SWIFT, it's much more granular from a transactional perspective as opposed to immediate access to balances.
The transaction itself. Confirming the transaction, yeah.
And we've had some conversations with SWIFT on how we could work together, but that was my understanding. It was theirs is predominantly transactional based.
Okay, that leaves Steve Hurst batting cleanup.
Morning, everybody. And my name is Steve Hurst. I'm from the Merchants Data Repository. I do, and I can chat for a moment while it's being set up. Thank you for the opportunity to be here today. Before I go much further, I'd like to introduce my colleague, Kevin Walsh, who's sitting in the back here. Kevin has a great deal, years of experience of running a trading and dealing desk in the custody environment using technology that is well settled in the banking sector. Much of that technology is relevant to what I'm here to talk about today, and when we break for lunch and throughout the afternoon, I hope you'll take an opportunity to meet Kevin and engage with him. He has much to offer to the conversation about an independent third-party utility. Thank you. Merchants Data Repository is a new independently operated third-party utility.
Can I just ask, Steve, just because I had to step out for a second, can I just ask Chris a question about the market confirmations? If you pick 2011 or whatever recent data you have, what portion of the auditing profession uses electronic confirmations as opposed to the paper? 10 years ago it was all paper, fax, et cetera. And I don't have a sense.
We would tell you.
Where we are, and I should ask it, like if they do 1,000 audits a year, however you would measure.
I understand the question.
Or do 1,000 confirms a year, what's the market now look like, electronic versus paper?
Our estimate is that we're still in the very early stages, still pretty low on the curve. It's probably no more than 15%.
So well over 85% is still in the paper fax world.
Correct.
And as you say,
moving quickly to electronic, but still it's still a long way to go.
Okay.
Even the firms all the firms that I cited, the 10,000 firms, the big four that use our service, they don't use it universally for many reasons, but we're getting there slowly.
And would it have been 2 years ago, sort of like,
It was
98 or 99% was still paper? And
correct. It's really been the last 4 years that we've seen dramatic increase in our
from zero to,
And what's really driven that are the financial institutions that have come to us and said, we don't want the paper anymore. We don't want to deal with the potential risk that exists in paper. We're going to mandate the service. We're going to require that this is the channel that confirmations come to us.
And maybe it's a question for Chris, or I see Dan Roth here too. When did NFA get to this? And
I'll let that Chris answer that question. That's a good question.
All right.
We began dialogue with NFA about a year ago, and they started to introduce the service. I want to say back the beginning of this year,
which was after MF. And so I think, by a funny change that I heard later, John Damgard had a friend that knew Chris, who sent Chris to Dan Roth, who sent him to Regina, and Regina said, we ought to try this.
That's exactly right.
I knew John Damgard would be in here somewhere.
He would take credit for it somehow, right?
Can I ask one question? I think you said there's a couple of levels of authority. Does your system allow for banks to just push out this data? Could it allow for that to be pushed out?
It could. We're not. We are there in a sense. We have a bank that does that today. We'd be prepared to do that for as many or as few as would be willing to participate. The challenge usually is the financial institutions' technology resources and their availability to support their own projects. But we could certainly accommodate that.
I was just going to comment, that gets into a little bit of the complexity of requiring this e-confirm stuff by rule, because a couple of the banks, and they're complying quickly, are having to get their documents in order to be able to comply with this, that are seg depositories. It's happening quickly, but it's slow. It's just it's slower than you would think.
But if we were you and we were to do it by rule, then you could have a phased compliance.
Right.
You could give some. I mean, there's ways to address it to get it in the rule books and then phase it as well, right?
Correct.
Steve, I'm sorry. Back to you.
No problem. By way of introduction, Merchants Data Repository was originally created as a trade reporting repository. We think the trade reporting repositories are one of the more important ideas promulgated under Dodd-Frank. If they had been in existence a few years ago at the time of the crisis, some of the problems, like with AIG, might have been averted. We think there are lessons that were learned there that can be applied here. Over the last 18 months or so, Kevin and I have been out in the marketplace talking to a wide variety of market participants. We've met with international commercial and investment banking companies, market regulators, prudential regulators, trust and custody banks, who have an important role to play here, we think, investment management firms, insurance companies, pension plans, sponsors and managers, and producers, merchandisers, commercials, and non-commercial end users in the agricultural sector. And one thing became apparent to us very quickly, that with all of the data, the transactional data that's being gathered by all of the repositories that are being set up for all the different asset classes all over the globe, how can you possibly use that data effectively if you do not also have access to the collateral that is underlying those transactions? It is not possible to assess risk on transactional data without having access to the collateral. And one of the important points that we think should be considered here is how, while addressing these problems, you might get a twofer. CPS SS IOSCO identified gaps in collateral reporting 18 months ago. The Commission held hearings and took testimony about the value of creating a central repository to collect collateral data that can be used for risk assessment, both by the firms and by regulators. There's an opportunity now, while we address the problems that brought us here today, to address that problem as well, and I think it's important to keep that in mind. We also worried early on that collateral considerations could have an impact on the clearing mandate. There are institutional investors that have become comfortable with having their funds held in individually segregated accounts under tri-party custody agreements at global trust and custody banks that are governed by ISDA CSAs. And in order for them to participate in the clearing opportunity that they are urgently interested in doing, they have to change their collateral protection mechanism from having an individually segregated account to having it moved into the system that we're all familiar here with futures. That has been problematic for some time. And regrettably, as events have played out, the concerns they have been manifested in ways that none of us ever imagined. MF Global exposed gaps in structures that everybody in this room believed were inviolate until quite recently. And Peregrine has exposed a dark side of our industry. And this double whammy has caused fair-minded people to question whether or not we should be entitled to self-regulation, and more importantly, whether questions are being raised about the fundamental structure of our market. And the people that are raising these questions are our customers. And a year ago, the customers that were concerned about this were in Stamford and Greenwich and Mayfair and Canary Wharf in London. And today, they're in Omaha and Minneapolis and St. Louis, and they're not investment fund managers. They're producers, they're merchandisers, they're commercial end users, and they know that there are collateral protection mechanisms that are available in the market, systems that are embedded in the banking system that are available to other investors in the derivatives markets that are not available to them. And I'm here today to tell you that there are ways in which we could make those systems available to that community immediately. One of the things that I'd like to address as we go through the afternoon is whether or not there are ways in which, as Jerry said, not waiting, getting started, if there are ways where we could proceed in parallel to test individual collateral segregation programs while the reporting systems that have been discussed by Chris and by my colleague at the end of the table for me confirm that has an impressive system. What Mike is talking about with the portal, all those things could and should go on as soon as possible. And I'm suggesting that in parallel with that, a pilot program should be initiated that would enable individual collateral segregation mechanisms to be tested as well. To put it very simply, there's a structural problem here that is perceived by our customers, and a structural solution is needed. So we're here today to give you some ideas about and a concept for how individually segregated accounts could be brought to market quickly. They're a fact of life at most swap dealers. It's the way that market works. These systems that exist today are clumsy. They are proprietary. They are operationally complex. They can be expensive, and the reason for that is they're not shared by anyone. Each dealer has its own system for managing these accounts. We think great things could happen if the dealers got together and instead of competing with each other to have the best technology, deployed one central platform in one central location, shared the cost, and made the services available to their customers as the customers perceive it. We don't think this is something that should be mandated. We think it should be optional from the customer's perspective. I'd also tell you that the technology alone is not going to be enough. There will need to be other things to address the loss of trust that's occurred in the industry, and we think having a central venue to house this platform would have several advantages. We have central venues for trade execution today. We have central venues for clearing. We'll soon have central venues for post-trade reporting. Why not a central venue for protection of customer funds? We think those the attributes listed would serve us well. They would encourage transparency, best practices, standardized systems, and lower costs. And we think having a neutral intermediary providing a central venue would facilitate those needs. We also think that there's a way to use a central venue, if organized by the industry and supported by the industry, to test the insurance markets. When you start getting into the details of the insurance issue, the central question is, what is the risk profile that's exposed to the market? In the same way that every FCM looks at a customer and tries to assess risk, the insurance markets are going to look at it the same way. They will look at the risk presented by a central counterparty for clearing differently than they would a collection of FCMs coming together to provide an insurance solution that's built upon a technology solution. And I would encourage you to think about insurance in this capacity. So, we've all talked about the landscape today. I'm not going to dwell on that, other than to say that the tri-party custody environment in the swap market uses technology that is well embedded, broadly distributed, and has been tested in a real-time environment, and that technology is available today. We're proposing to deploy that technology, working cooperatively with the trust and custody banks, using the same systems they use to facilitate the tri-party custody model in a single-purpose entity operated by a neutral third party organized by this industry. We think that FCMs have the relationships with the customers. It should be FCMs that provide this service to their customers, and we think the customers ought to have a choice as to whether or not they do business in the traditional model or whether they use a new third-party service to enable them to hold their funds in an individually segregated bank account. The service would be able to maintain a secure database of portfolios that is sortable, reportable, and available to customers and regulators, addressing some of the issues that Alan discussed in terms of standardizing process and keeping the parameters consistent. We'd address the data gaps that were referenced by the CPSS IOSCO report more than a year ago. You'd give the customers that want the ability to hold their money in a bank account the ability to do so, and there'd be a transparent view of the funds on deposit at this facility that would be available to customers, to FCMs, and to regulators. The key features of our proposal are that this is a service bureau for the FCM community. It is the FCMs that will make this service available to their customers as they see fit. We're proposing a utility model. This entity would undertake no other activities. It wouldn't undertake any risk. It would exist for one purpose and one purpose only, and that is to manage the accounts of the customers for the FCMs. The accounts would be held at custodian banks that are settlement banks of the DCOs. This would be a regulated entity with a rule book subject to CFTC oversight. The rule book would supplant the control agreements that are common with custodians in the over-the-counter market. The custodians would exercise absolutely no discretion in managing the account. They would be bound by the rule book, and the rule book would be well understood and available to customers. The FCM business model would be preserved. The FCMs would remain as the clearing member. They would remain the primary face with the customer. They would retain control over the margin requirements and position limits that are set when they bring in a new customer account. They would simply outsource the managing of the custodial accounts and the development of the technology to a new independent entity. It would be a shared outsourced solution that would leverage existing custody infrastructure. This is a simplified version of the way business has been conducted in our industry for years. We have two customers that are conducting futures transactions through an FCM. The funds held in a collateral pool, an omnibus account that is segregated and cleared at a clearing organization. The model we're proposing is shown here. Backing up, there are your two customers using the traditional model. Those same two customers are at the top of this slide. They're conducting their business the way they always have. But customer 3, shown here, has opened an account in the customer's name, held by the repository, at a trust and custody bank that is also a depository of the clearing organization that is going to undertake to clear the trade. The clearing organization would hold a separate account at the same financial institution. As margin is called for to support the trade by the DCO, one account, the DCO account, calls for money from the customer account inside the repository, which is facilitated by a book entry transfer in exactly the same way that margin moves in the over-the-counter markets today. This is nothing new. This technology is available. It can be deployed easily. I shouldn't say easily. It can be deployed without having to invent anything new. It's a matter of implementing the will and getting the job done. In an even more simplified process, again, we have the repository at the bottom of this slide. Here it's in the center. You have the client of the FCM that is permissioned by the FCM to use this new facility to hold its funds. The FCM provides the customer with access. The customer opens the account at the repository. As the DCO calls for margin, the repository allocates funds to the DCO's account. As the DCO pays margin, the flows work in reverse. All accounts will be held at leading trust and custody banks that are also DCO repositories, and the relationships and responsibilities between customers, custodians, FCMs, and DCOs will be defined in a rule book approved by the Commission. For end users, having an independent, neutral third party holding the account will be helpful in addressing the bankruptcy issues. Structural protection will be provided, which will address the concerns that many customers are raising today. The funds would be held on deposit at leading trust and custody banks, and the rule book would define rights and responsibilities. The funds on deposit would be completely transparent, both to customers via established banking platforms and easily verifiable by FCMs and regulators. For the FCMs, the benefits here are restoring trust and confidence in the market. We have a structural problem. This addresses that problem with a structural solution. The FCMs would maintain the customer relationships, continue to enjoy their access to clearing, be able to provide a full segregation option for customers that are willing to pay for it, and enhance their existing business models. We think there are cost efficiencies here that could be realized by a cooperative effort amongst like-minded firms that leverage existing custody platforms, and the result would be restored trust and confidence in our markets. In conclusion, I'd simply say that my roots in this industry come out of the agricultural industry. I started out years ago trying to create new competition in this industry by launching a new central venue for trade execution. We took the old Merchants Exchange, some of you will remember, had it designated as a contract market, and had a go. It didn't work out well for us, but we learned a lot. But our roots are in the agricultural sector. The people that I have my best contacts with and my organization has its best contacts are in the agricultural sector. Those people don't understand how this happened. They view it as a structural problem, and they want to see a structural solution implemented now. I've been working on this for 18 months. Chairman Gensler, you and I have never met. For us to get started doing what we want to do, it's not that complicated. We need a safe harbor in which customers, and they're out there right now, customers can test the model that I'm proposing, where they could open up an account working with their FCM and with participating clearinghouses, and with brokers that are also, we have a handful of brokers that would like to test this as well, where they could actually put a trade through and not have to worry about being assessed an excess margin for putting something through that might be considered to be unmargined under the rules, where the brokers don't have to worry about being hit with some sort of penalty, where the customers know that the CFTC is involved in this. And you'll see in the testimony that was delivered yesterday to Congress, the National Grain and Feed Association is calling for a pilot program. I would urge you to consider letting us implement that pilot program today, and let us proceed in parallel with the other excellent programs that are obviously moving forward right now. That's what I'm here to ask for today, and I'd be happy to answer any questions over lunch or through the rest of the afternoon.
Thank you. I asked Steve to come because he does have obviously a different model. This is not a substitute for any of the technology solutions that we've been focused on the previous speakers, but does warrant some consideration in reevaluating our futures model, or our intermediary model. I have a couple of questions, though. Is this utility contemplated in the CEA? I mean, we require money to be held, customer money to be held in certain accounts. Would we need to change the rules to accommodate this?
Yes.
Okay.
And I might add, just to be complete, data repositories were envisioned, but not data repositories for collecting collateral data. I think that's a relatively small change. There is nowhere in the CEA contemplated anything close to an entity that would actually hold and manage customer funds, and I think this entity would probably need to be dually regulated as a bank in cooperation with SEC. So there's a banking function here, and there's a repository function here. And I think we're going to need to proceed carefully, but I don't think we have the time to wait for all the rules to be implemented, which is why I'm proposing the pilot program in a safe harbor environment so that the rules could be addressed while we test the model.
Let me just ask you another, the long pole in the tent on this one is bankruptcy protection.
Correct.
You know, does this protect you from a fellow customer failure, and what about pro rata distribution?
As Mike said, there are a host of really smart bankruptcy lawyers that are looking at this and other models. My basic point, to answer your question, is that having a neutral, independent third party holding the funds, I think, will be very beneficial in that analysis. And I would also point out that 766H of the Bankruptcy Code and the Part 190 rules were tightly drafted to take into account the types of entities that existed at that time. There were no repositories, and there was never a facility like this. So I don't think the code would apply, and I think there's a lot of advantage here in addressing that problem in having a neutral third-party entity.
Well, I mean, just my only concern with bankruptcy is you don't want to throw customers into an untested, uncharted solution that courts tie up for months and months. We don't ask any of the customers in Europe about, in Lehman or in MF, how they're faring, and to have uncertainty in bankruptcy is probably the worst fate known to man in terms of getting your money back. So not that we shouldn't consider this model, but I just want to make sure we solve for the tough questions.
I understand, and what I'm suggesting to you is the way to do that most efficiently is for customers that are willing to take the risk that you're addressing there in a pilot program environment for a short period of time with a limited amount of capital at risk. That's going to be the best way to give the bankruptcy lawyers what they need to provide that level of certainty.
And you brought up the National Grain and Feed Association, and they testified yesterday in the House Ag Committee. They have also sent us a letter that I asked be put in the record, and as has the National Introducing Brokers Association, who also have a letter. We'll include that in today's kind of meeting record as well. I'll give to the reporter.
And those are the letters that describe the segregation regime that they prefer and the pilot program?
Yeah, this doesn't have their full testimony from yesterday, but it talks about focusing on a technology, kind of addressing the narrow. They had a whole range of solutions that they were looking for in terms of customer protection, but in terms of technology, they're very supportive of developing a technological verification solution. Believe it or not, we've actually completed all the presentations on time, which means we're gonna break for lunch, but I think Cliff has been sitting over here and has some thoughts. To kick things off, just to whet our appetite for afternoon's discussion, I thought I'd look to Cliff to raise some questions that we ought to contemplate.
And I realize it's because I'm so soft-spoken and modest in my views. But I guess, the first thing I would just say, and others on the committee obviously can speak to this, we actually, as a custodian, and we've talked a lot about custodians, and obviously our customers are facing the challenge of being forced into the clearing regime, just as the clearing regime has been proven to be broken. So if you're asking about feedback from the institutions that manage American savings and retirements, they're petrified. And I would say fairly so, because the simple point and the test that I would ask, and we've all been in the industry together, most of us known each other for 30 years, is would in fact the various debacles have been solved or prevented through the mechanisms which we're discussing today so far? And the answer, on the whole, is no. We're talking REFCO, talking Lehman, talking MF, talking Peregrine. Now, is there a panacea for all the problems? I mean, the answer is obviously not. There's some things, the answer to your question, and obviously we think tri-party custody should be allowed in the U.S. The reason what Steve was talking about is because the CFTC prevents it by rule. Elsewhere in the world, it's allowed. Does it solve the bankruptcy problem? It mitigates it. It doesn't solve it. It would prevent the fraud problem. But so I'm not suggesting anything is a panacea. But I think what we need to think about is sort of in the context of this requirement and the timeline. You guys voted, so it's out. We've got the train has left the station. My clients on a rolling schedule, middle of next year, end of next year, are going to be clearing a huge amount of product. They have fiduciary responsibilities, including criminal penalties, to their investors in terms of how to deal with this system. And I mean, I feel for the FCMs, but that's the issue we should be dealing with. And the fact that they're right seems to me to be the fundamental question. So I would just suggest that as we address this, we actually think about the various real problems that we've encountered, and I enumerated the 4 biggest examples. We have a problem of fraud. We obviously have a problem, sorry to be indiscreet, Chris, but we obviously have a competence problem. And I know as a banker, as one of the senior guys at State Street, I sign an agreement which makes me criminally and financially liable if we screw up. There's a clawback, the famous clawback stuff. Well, one of the questions I've got is, hey, what are the consequences for some of the things we've seen where people clearly were not doing what they were supposed to do? So fraud is one issue. Then I think there's the issue of bankruptcy. And, if you're asking that America's savings be forced, not voluntary, as it has been with futures up until now, but now forced into this structure, I think you need to have an answer to the people who hold America's savings as to how in the world you're going to protect them in the event of a bankruptcy. I think the third thing that you need to look at, obviously, and this is a general issue about this, is operational efficiency. One of my smartest and biggest clients is sitting to my right, and I can defer to Superna about the operational complexity of this. The commission has taken this into account in terms of the phasing, but again, this is not a simple thing. The costs are not modest, and indeed, in some cases, the costs may outweigh the benefits for some of the products that are used today. But fair enough, if it's transparent. I also think there's another hidden point in all of this too, which is pretty straightforward, which is, the process of market change obviously hinges on incentives, and the reason why some structures, for example, tri-party custody, aren't used is because of the perception. It was a successful lobbying campaign at the CFTC said this would limit the profitability of FCMs. CFTC, in its wisdom, well before any of you there, said, okay, that's more important than giving customers the choice of avoiding the kind of Peregrine problem. And I think that All of those sorts of issues need to be on the table. I think Dodd-Frank, it lays some of these principles out very clearly, but it's the level of detail that's really going to be required to make some of these things work. And unfortunately, I don't think there are any simple answers, but let's look at at least look at the fraud question. Let's look at the bankruptcy question. Let's look at the operational efficiency question. And I think we also have to look at the conflict of interest questions, honestly, both on the part of the regulators and the self-regulatory bodies, and frankly, in terms of the industry, because I think you've seen that there's an inherent conflict, and I'd argue this is probably the biggest thing that would scare me, is the conflict inherent with institutions that are both major market maker participants and customer clearing. And it's that risk of operating both their prop accounts and their customer accounts. And I think if you look at the Lehman problem, and if you look at the MF problem, that was really at the heart of it. I suspect that'll be part of what was going on at Peregrine, too, in the end. It's very easy to step over the line, given the current model, which allows you to bundle these two activities. And I would also, by way of, to be finally provocative, I think the initial steps on swap clearing aid and abet a bigger danger from those conflicts than existed previously. So in fact, in terms of the detailed implementation to date, we're worse off now than we were pre-crisis. Sorry if I was too mild-mannered, Scott.
No, thank you. We're going to let that just sit on the floor for a while. We're all going to go to lunch, and we're going to have this discussion. For the TAC members and the panelists, we would like to continue this discussion downstairs. Take the escalator down. You'll be directed into where lunch is being provided. And then we will be back here at 1:30 to complete Cliff's thought and to have everybody else give their thoughts on technology solutions, broader solutions, and how we fix this thing. So I appreciate everybody's participation today. Thank you to the panelists that were able to deliver on time a lot of good ideas. So thank you very much. The rest of this, you guys will get a kick out of this. I just did a CNBC Live, and they had a technical difficulty, and it got dropped halfway through it. So clearly technology is not perfect. And I got my first Santelli rant. So so I got Santelli interjected. Using technology. Why we hadn't done it earlier. And obviously there's no, that was, we got to get on with a technology solution today. What is fascinating, and I think about it, I see people like Chuck and obviously Brian and Superna all using, and some of the other technologies firms here are all driving technology in this market, and with what ICE is doing to make electronic markets globally, what CME does with the Globex system is utterly amazing. And obviously we can do so much more with technology. Superna has obviously clients all over the world that she has to serve and document as where her firm has put money and where their funds are and how they're going to protect them. Every one of John has had clients. Chris has had clients. Gary had clients. So all of these are technology-based solutions going forward. So I think the consensus obviously today was it can happen now, and we have to move forward on it. I think what's really important is to focus on what the solutions and some of the nitty-gritty. There are some questions here I have about, is it a push or a pull for this data? Does it matter? What about cybersecurity? Are we opening holes in to create bank exposure that other people can use to get access? Not only do we have to protect customers from fraud, we also have to protect them from the next fraud, and that's a technology-based fraud. That's a cyber threat, and we need to think about that as well. So I hope, we can do away with the fax machines, we can do away with the post office boxes, but the next threat is obviously going to be a cyber threat or something like that. So as technology moves and innovates and we use better protections, and I'd be, Alan, these are kind of in your wheelhouse, and Chris, you as well. How do we use technology to protect against other technological threats going forward. So these are some of the questions that I hope to have. I really want to have the experts at the table. I've been able to ask questions, and the chairman's asked his questions. So I want a free flow of discussion among the experts. I'll call on Gary next to get us started this afternoon. He's been very patient.
Shockingly quiet.
All morning without the light going on. So I'm going to, let's have a discussion. I'll just sit here to recognize people and kind of maybe refocus it a little bit and drive it. But so those are some of the questions I have. How do we get it? How are we actually going to implement it? Broad framework. Gary, please.
Yeah. Again, thank you. And again, it's always enjoyable, and I think this is one of the very useful forums that the Commission hosts. And so, thank you, Scott, for hosting this and being such a diligent expediter of these discussions. Again, I think some of you have heard me say this in the winter TAC. I forget whether it was in February or March. Heard about these ideas, listening to these ideas about daily reconciliations occurring at some SRO. In fact, we do that every day in our JV in China. CITIC New Edge, under the auspices of CSRC, is a member of the China Futures Margin Monitoring Center. And every day, we do today what is being suggested for the United States. Every day, we provide records to CFMMC related to the equivalent of our segregation calculation, and we provide backup access to documentation. In fact, in China, it's the CFMMC that sends out customer confirmations. It's not the brokers themselves, interestingly enough. That's not something I would recommend adopting, but that's how far the system goes there. And every day, the depositories where we have our clients' funds provide access to CFMMC. And every day, CFMMC does a reconciliation between what we say we're supposed to be segregating for our customers versus what the depositories say they are holding. And again, it's a far, far less complicated system. The options of where we can keep our money are far less advanced. And so you just can't take that system and transplant it here easily. But in fact, as Commissioner Chilton suggested, we can look abroad and see this system working every day as it has been for a number of years, because unfortunately, China experienced the same type of issues as MF Global and Peregrine prior to 2006, and that's why CSRC ordered the creation of CFMMC. It's an entity owned by the 4 exchanges in China. We did make a submission back in March to the Commission. We included it, and it's online. I checked it yesterday. Both in Chinese and English is a presentation of CFMMC describing their system and our cover letter. So I do recommend that as part of the studying of the system, that everybody who's looking at this actually look at a system that's today working every day. So it's not theoretical, it's actual. The other thing that I think is very, very important as this debate goes forward, and again, firms like New Edge and certainly I believe all the top 10 firms holding customer segregated funds are combined broker-dealer FCMs. I am very, very concerned about any system that only looks at one side of the ledger. Right now, we have 5 potential buckets for customer funds, 3 on the future side, 2 on the security side. And I think that any solution that only solves half the ledger is an issue because the fraudsters know how to do arbitrage. And if the system is fixed here but open there, you can be sure they'll figure out how to do the fraud there. And I think this is an excellent opportunity for the Commission to work with the SEC. The SEC methodology for, they call it reserving customer funds instead of segregation. There's reserve calculation that we perform. Even the approach is very different. Effectively, when we receive customer funds on the security side, we're not depositing it until potentially a day or even later in a seg bucket. Custody control is different. The way they look at money and the way they look at securities is different. And I think that once and for all, the SEC and the CFTC are going to have to look at the way customer funds are protected and see if we can harmonize it, because again, I think if we don't, there's an issue. And I'm also very sensitive to the issues you raised about 30.7. And again, I think it was March 2011, IASCO published a survey of all the principal customer protection regimes around the world. And I know a number of us, dusted it off post-MF Global. And I was really struck with how differently funds are protected from jurisdiction to jurisdiction. There are jurisdictions that absolutely prohibit brokers from topping up customer funds. And then there were those, like the United States, that encourages topping up customer funds on the future side, okay? Not necessarily on the security side. I think that we're never going to solve 30.7 until there's, again, a greater harmonization or a greater desire to see if there's some potential harmonization, among the customer protection regimes. But I'm not optimistic, realistically. And again, that's because insolvency law is so different from jurisdiction to jurisdiction, and in many ways, insolvency law is what drives customer protection in the first instance. But that being said, I do think we can get better. And I think the type of leadership that you are showing here and the Commission is showing post MF Global and Peregrine is something that needs to be replicated around the world. I'm actually surprised that I haven't seen more push by other regulators around the world to re-examine the way that customer protection is handled. Because I've been around too long, and but for the grace of God, there go I. We may hit a bad streak here, but it's going to happen somewhere else, sure enough, later. And I think this is an opportunity for all the regulators, perhaps under the umbrella of IASCO, to really take a hard look to see if there's some principles that can be seen. And one of that may be the access to the ultimate depository accounts, the access to the segregation computations, the daily comparison, so that if you, in fact, just take the feeds from the first level of the 30.7 funds, the brokers in London or the brokers in Singapore, you have some satisfaction that at least the local regulator is looking behind there. Today, I don't think that's the case. Today, I don't think that's the case. So, those are some of my thoughts. I mean, again, I echo what Mike said. I mean, I've been around a long time. I heard the debates when I first entered into the industry. It's literally just about the time of the volume investors matter, and it was then that the customer insurance was being looked at, and a study was done by NFA, and then we really haven't heard about the subject for 25 years. I do think it's worth looking at. I do think we have to consider that, and I know a lot of my colleagues won't like that I'm saying that, but the train is coming, and the question is whether we want to be run over or be on the train, and I prefer to be on the train. The question is, it's a hard topic. It's a hard topic how to fund it. I'm not sure that SIPC would have been able to adequately cover the entire amount of the MF Global loss, and what would that mean? And I think, but we got to look at it. And I think that the suggestion that Mike has made is an excellent suggestion. And if IFM or some other entity can start the study, I think that's a really good thing. Individual customer segregation, yeah, I think it should be looked at also. I think obviously there are going to have to be amendments to the bankruptcy laws to tolerate it. Third-party custody relationships sound like a great idea, except that I'm not sure what protection they ultimately afford customers because of the principle of prorated distribution. But that being said, I also think that the Commission is going to have, as you say, that, you solve one problem, but you create another problem. There's going to be an interesting issue of equity. If some customers are able to buy individual segregation, it means that the remaining pot's going to be less. And instead of customers receiving 71%, they're going to get 45%. And, that's going to, create issues of policy that are going to have to be discussed. So, again, obviously complicated. The steps that the CME and the NFA have taken are good, and the steps that firms have taken. For our own clients, we issued something called an AT 601, which is similar to the old SAS 70, a statement of internal controls, and I think the clients who got that from us were pretty happy. But it's a date and time. It says our internal controls up until the date it was issued were fine. The problem is the date they received it was not the date that was covered. So it gives you some protection. But again, I don't think anything's going to beat the online record. I don't think anything's going to beat the daily comparison of what we think is supposed to be in SEG, what we're saying is supposed to be in SEG, versus what's actually there. And I agree absolutely with what Chris has said. Let's not try to do everything at once, because you won't do anything. We can start pieces by pieces. We can do what we can do real time. We can do what we can do top day. We'll figure out a way to deal with the open trade equity from the exchanges, given the fact that there's got to be daily balancing and issues like that. But let's at least start doing what we can do. I'm always struck when I think about the debate about this is that, every day I've got a feed from all my personal accounts going into my Quicken software, and I press a button and boom, I can see theoretically what I think I have is in fact what I have. And it seems to me that the regulator is overlooking the billions of dollars that customer funds have to have at least the equivalent capability I have on my personal Quicken. That just seems a minimum standard.
Steve, maybe you don't have to do it right now, but give some thought to this, how we harmonize. I think Gary brought up a good point with the SEC. Steve is with FINRA. They're self-regulatory. And if you have thoughts now, by all means, but give it a moment. And
Well, I think the answer is to start the dialogue. And I think Gary's 100% right that we have to look across the industry. Before I came, I asked some of our staff to do a comparison between some of the proposals here and what we're doing on the securitized side, and there's clearly very, very different approaches in terms of these things. We're dealing with different instruments and different structures, so there should be justification, but we should rationalize the differences, because what happens here could happen tomorrow on the securitized side, and it's really good to do that. Although I would also agree with what Gary said, is that you need to get started. And it's more important to at least start this process here and bring the SEC along during the process as much as possible.
maybe, Alan, if you could respond to that cyber.
Yeah, absolutely. I'll respond to a couple of the things. I think your first question, Commissioner, was on the push or pull. I think it's appropriate when you've got your personal Quicken account for that to be a pull. I think that people there have differing needs as to how often they want to see that updated. But I think with what we're looking at here, we really would want this to be a push system. I think that you would want everybody who is submitting information into whatever entity it is that's going to collect this to be doing that on a push basis. And I think that's going to evolve. It's going to evolve in two ways. Firstly, in terms of the people who are able to, push that in an automated fashion. That's going to take time. Maybe it can start off with the cache, with the information from the FCMs themselves, with the information from the DCOs, and then we may need to more slowly expand out into some of the other depositories. But the other way that it's going to expand over time is with the move from the batch to the real time. I think it's very important that as we start to put this in place, I completely agree with what Chris said in his opening remarks, that a batch system is how many things are happening today, and that's certainly how I think we're going to have to start this off. But increasingly, we're seeing in the swaps world that real-time views of this are becoming very, very important. I think that the same will be true in futures too. So we should definitely have in mind that we're going to be seeing an evolution from more of a batch process to more of a real-time thing. So that's to answer your sort of push-pull. With regard to guarding against the technology fraud, I think there are two different sides to it, and actually I think Chris at the other end is going to have quite a bit to say on that too. With regard to how we look at it, most of the connections that we have with our customers, with the DCOs that we work with, are over secured private networks. So very, very little, if anything, that we put in place goes over any kind of public network. It all comes over our own private global networks. Anything, in fact, that does go over the internet goes over, very secured lines with VPN tunnels and secure protocols on top of that. So, one element there is that you're ring fencing the network. You're making sure that it is not part of the public internet domain. But the other thing, that's certainly appropriate for the players that I've mentioned, the big custodians, the FCMs, the DCOs, they're all certainly going to have the capability to connect in that way. But I think I'd actually pass over to Chris at the other end, because I think that this, guaranteed confirmation and security is probably, maybe a little bit what you guys have got.
Yeah, certainly. I think, from our perspective, I understand the whole discussion of push-pull. We're a little less, I guess, concerned about that. From our business, we could react to either. The biggest challenge is, I think, as Alan, as you alluded, is bringing some of those players along, big or small. Their willingness to react with technology resources is many times a challenge. And that's something we'll just have to, I think, deal with based on some regulatory oversight.
I think it's probably worth just following up on that as well. I sympathize with some of those banks, or whatever institutions, those depositories, on meeting those technology challenges. We're being asked by our customers to implement huge, massive changes to our systems as the result of not only the Dodd-Frank Act, but some of the other rulemaking that's coming through. And we totally support it, as do our clients, but it is a huge amount of work. So I think we shouldn't underestimate what's involved there, but the extent to which these things can be standardized and centralized always makes it a lot easier. We found on implementing gross customer margin, for example, that just getting the industry together with the various technology providers and the DCOs, and then extending that out with the help of the FIA to the FCM community, we were able to get a framework that was not only meeting the rule, but a little bit easier for us to implement from a technology perspective. So when you move these things, from some kind of regulatory oversight as opposed to the market forces, it does sort of force the community to come together and can make things easier. So whether that means, a rule from the commission or, a leadership from the NFA or the CME, I'm not sure. But I think that the extent to which it becomes mandated does actually make the technology solution easier.
On that point, I mean, we obviously have the two largest SROs in the room, and both of them are saying, using Confirm, are saying the same things in terms of technological innovation. What is the timing that we need to be thinking about here? I mean, we've got banks, we've got FCMs, we've got SROs here. How does this all come together, and what is the expectation in terms of timing to get this into a better place than we are today, and then ultimately in this real-time space that we're evolving to?
Well, with regard to the system that I described this morning at NFA, I think when it comes to the nature of the technologies and push-pull, I think that what we've envisioned, which was a mere weeks ago a discussion, and now it's moved into something that's being planned, there's a number of accessible technologies that NFA can use to take the information that's gathered every day from clearing and non-clearing FCMs, the SEG information. As I said, we can very quickly move to either e-confirmation or online confirmation manually to check balances. But what we want to be able to do is to have the data go into a system and into databases, which we're going to quickly get over my head. But then we want the ability to go out and confirm that what the balances that are in the information that's come in, go out and reach and confirm that the balances are there. Certainly, clearing organizations and banks are much easier to confirm than other categories of custodians or other good seg locations, and certainly complications with 30.7 that get beyond a portal or a view to the rest of the world. But we should move ahead with the easier part first, build the databases of getting the information in, build the technologies to go and confirm, which is the vast majority of the SED funds that are here and certainly would have caught the Peregrine thing. So when it gets to a timeline of how fast NFA could build something like that. As I said, I think the political will, I used that term earlier, this is my take, was not there and there wasn't the urgency for it. Now that we've really sort of focused on this and started to think about, okay, what would that cost? How long would it take? I'm not prepared to do that here today, but we are rapidly having discussions about, we are currently having discussions and rapidly ramping up our picture of how long that'll take. And Commissioner Chilton contributed today by saying, just do it quickly, please. And we get that. I heard it loud and clear, and I think our organization did. And NFA is in a very good position to do that because we collect all this data even from the non-clearing FCMs, right, like Peregrine, right? And there are a lot of others that are in the ag communities and such. And so we get that information, that SEG information now, and we can certainly confirm to banks relatively easily. That isn't super sophisticated technology that we're talking about. I hope that answers your question. That's confirming with the banks. One thing I will say about your Quicken account is the bank says that money's in the bank. The money's not really in the bank. They've lent it to people to build buildings. And so this is a little bit of a different, the nature of this is different. There's not a criticism of the banks, but the depositories that have the money in cash, whether it's the DCOs or bank depositories and broker-dealers that are relatively easy also, that we can do that, I think, that's doable and pretty fast. But what's pretty fast, I wish I could tell you, but I don't know.
Brian?
We're, very much aligned with the NFA on this whole initiative. So I think one of the things that, we also have to work towards is, parity in terms of how we are expecting information to come in from our customers and our clearing firms. And so I think the efforts of the SRO, subcommittee is definitely, borne a lot of fruit. And hopefully that came out this morning in terms of things that we have collectively as an industry pursued. No, is it the answer to all of these questions? Not in the least, but, I can tell you from the CME's perspective, it's top priority to us to be able to move forward on the initiatives that we talked about today.
Jim?
Commissioner, thank you. I guess the first question from a Renaissance approach to technology is, are we comfortable with the process, right? Technology is an enabler. And what I don't get a sense is that the process is nailed down. What we're doing is, it seems that we're looking to build the regulator the tools to do a better job. Okay? The question is, do you know what those tools are? Because it seems we're going to move toward an exception-based review, right? You don't have unlimited resources, and you're going to develop some filters that are going to say, okay, this needs further examination. Exception-based reviews are very problematic. They have a lot of false positives. They can be manipulated. You can basically balance books so it'll just pass through. So the question I would have is, your tools, your needs have to be developed in concert with the process. The process has to be evaluated and make sure that there are no holes. I've heard that we're taking certain parts of the process and putting a lot of work behind it to automate it. Unfortunately, when you take individual components of a process and automate them, it creates gaps. And here would be a perfect example. If we're not sure if we're going to go for full segregation or not, the technology needs for full segregation are very, very different than more of a consolidated approach. It's more horsepower, it's more technology, it's more feeds coming in. And the thought will be is, if you have one feed that doesn't get to where it's supposed to go, it could render part of the examination or review not worthwhile taking a look at, right? All the files have to be in at the same time. So the way Renaissance normally takes on a project like this, and I think we all know this, is you make sure that the process is bulletproof. This is the process you want to automate, okay? Then you say we're going to move forward. We could talk about insurance, but when's the most expensive time to buy flood insurance? It's after a flood, right? We've had a flood. So the question is, it's expensive because there's a lack of confidence in the system. And my thought would be, on the buy side, is, we're going to throw out insurance so the foot can come off the pedal, we can take a little bit more time, and maybe the sense of urgency is no longer necessary. Again, I think the insurance should go along with it. I think it will go down as processes improve and time elapses, but we need to demonstrate as an industry that we've got a process that is worthy of automating. And so when I hear the different components, I really want to go back to the folks who are going to use this data, find out how they plan on using it, what tools they need, what filters they're going to put in, and make sure that from the very beginning, that information that comes down the pipe will meet their needs. Because the last thing you'd want is to spend $500 million or $1 billion, sit down at your computer and say, I'm going to review the first 100 exceptions, and the first 99 of them is because a file didn't come in. All right, so I just want to be cautious about saying, let's move forward without you signing off on someone has come to you and said, each part of this process, swift detection is the best deterrent, right, has been signed off, and someone has thought about all the ways this could be manipulated or end around. And at that point, then put it out for automation. So that's kind of where we come from the whole process. Is we don't start automation. In fact, automation doesn't take as much time as the vetting of the process. Automation is something that will get done once we're very comfortable that the process meets the need.
Mm-hmm. Bob, you had a...
Well, I had two things, I guess. One is I would just reiterate what Jim said, and I was struck by what I think Mike said, that understand the segregation calculation before you build. And I think it's important to make sure that you do go through the process of understanding what it is you're after and actually define in a very formal way the requirements. I think until you do that, it'll be very difficult to understand, how much or how long it will take and how much it will cost to build it. Otherwise, you'll end up in a situation where you're continuously adding requirements to what you're trying to build, and it will extend the time of delivery. I think the second thing I'd say, again, getting to the requirements, and I thought about it as it relates to the Quicken comment and also your comment this morning about seeing your balances on your mobile phone. In both of those situations, you two were the end customers. And what we talked about this morning seemed to be a two-way reconciliation between, the FCMs and the depositories. And I'm just curious to know whether the customer view needs to be factored into that reconciliation as well. I don't know the process well enough, but I would think that potentially fraud could occur by an FCM sending out customer statements to their customers that didn't reflect necessarily what was at the depository or at the FCM. And how do we close that loop off and do a three-way reconciliation where somehow the customer is brought into that process?
Yeah, I think that's a very important point, and I think it's also closely tied to another gap that I just want to throw out to the two SROs that Jerry brought up when he walked us through that SEG statement, which is that verification of the liability side. I think a lot of talk, a lot of work is being done on verification on the assets, and I clearly understand that that's where the fraud has occurred most recently. But if you close that loophole, they'll look for the next one. So it strikes me the liability and verifying that liability all the way through from the client view to the FCM to the DCO is really critical as we look at this. That's why I put in the liability on one of my 4 pillars, or 2 of my 4 pillars there. And there is an issue there, particularly on the futures world, that you've got different levels of disclosure as you go along that chain in terms of the detail, and that there is, at least at the moment, some netting that is going on there. Now, the gross customer margin rule is going to change that when that comes into play, but that's only going to change that for domestic exchanges and clearinghouses. So you're still going to have a more complicated situation on 30-spot-7. So I completely agree with both of those comments. And I think that what the SROs have got in place takes half of it, but hasn't really looked at the other half.
Chris, when you have this conversation about bringing all this data, and Brian, the same thing, do the FCMs and the banks get together and talk about how they're going to confirm data, or do you go to the banks and then you go to the FCMs and say, this is how we want it? Is everybody in the room having that discussion? Or are you just telling them, deliver it today and I want it gift wrapped?
Well, I guess I would say we haven't set up a formal process to review this, and certainly in business requirements and the project management and all of those things that were just described all have to be done. I completely agree. And NFA is pretty good at that. NFA has the data from firms coming in now. So CME could certainly do it, but they don't have the non-clearing FCM's data coming in. So we have the processes, and the technology people have to go through a serious review of the processes, and more time in the process than in the building. Completely agree. We have, aside from Jerry and Mike being on our board and numerous others, and a lot of input from the members, that we have a lot of people that contribute to that. But on this particular project, I don't have an answer for you because we're just beginning this. But we anticipate getting a lot of member input as to, particularly when we get into the banks, I think are fairly simple because we've got some of that in place, and the online process is fairly simple. And the technology guys could probably answer that for you. I just don't, and I'm not armed with the answer myself. But the more difficult questions of FCMs being good seg locations to other FCMs, particularly 30.7, that's where we're going to need member input, frankly, is in those processes. And that has to be done before we begin building the technology. I agree with that completely.
Yeah, just a couple thoughts here. And I think there's been some great comments over here about understanding what we're actually trying to accomplish. And I think a couple of questions that come to mind, we first have to determine what is it we're reconciling or verifying. Are we verifying a particular bank balance or custodial balance, or are we verifying the seg calculation? The seg calculation holistically is going to amount to something. Jerry's was $3.5 billion, I'm 28 billion, whatever the numbers are. But at the end of the day, that and capital are pretty important. And I think, that's why I think it's really important to get into the weeds and really get a clear understanding as to what we want. What data is really most important? If you've got a firm who's reported $4 billion in seg funds, and the regulators go out and confirm that there's $4.5 billion in all of the different depositories, plus they have $100 million in capital on top of that, I think you can sleep at night. Do you really need to delve into each individual line item and confirm it? Because I think, I'm not saying we can't do that, but I think it's important to, wow, look, there's two of them.
This is oh, the regulators are doubling in front of us.
Right.
It is the swaps market, right? This is my brother, Rob Gensler. He works at T. Rowe Price, and as you might have gathered, we're twins.
Hi, Rob. We've heard some of the stories and mischief you guys have gotten into.
It was all legal, though.
Right.
And transparent. So I was just introducing him to Scott. So. CNBC yesterday, Rick Santelli did a piece. It wasn't that favorable on me, but he did a piece yesterday about this Peregrine situation, I guess 2 days ago. And they then put up a picture of Chairman Gensler, but it was Rob's picture. CNBC.
Right, it was my file photo from T. Rowe Price.
Ran with a picture of Rob instead of me, when Rick Santelli and a certain senator was calling for my head. So Rob stood in for me for that. So, what's that?
It's good to have a spare.
It's good to have a spare. That's what my folks said.
It's the least I could do.
I'll be back.
All right. I'm sorry, Mike.
Anyway, no, no problem. So I don't know if you got my point. I mean, I think we just have to be careful as to what how far we want to go or how far we need to go, right? I mean, once you get into the weeds and start going line by line on that seg report that Jerry put up there, and some of them are a lot more complicated than that, there's going to be all kinds of false positives, and it would make it very challenging to identify a real problem. So that's my point. I mean, well, let's just make sure we do the right analysis and make sure the data we're requesting and how we analyze it is really accomplishing what we set out to do.
Pierre?
On that point, I would like, at some point, a number of participants said we need to aim for real-time reconciliation. I don't know about that, because real-time reconciliation is very useful when you want to reconcile transactions, the activities that is going on. But if you focus on balances and positions, you really do not want to do real-time, because this is where you get all the noise, because you have all these in-transit transactions, and you will never equal in your balances and positions. So I think it goes back to what do we want to achieve, what is the process that we want to aim for, and then and for that, and not try to overcome and end up with something that may not work.
Let me take you back to a day in October, late October, 3 days, in fact, in October in a certain MF Global. And I'll take issue a little bit with that because that was money in, money out, and the money was constantly being turned over, and within 3 days, $1.6 billion was missing. And, you know, when the music stopped and it went into bankruptcy, there was money coming in and coming out on a regular basis. But when the music stopped, customers didn't have a seat at this table. And so I do think that we need to think about the real time in some respects because of that situation.
We need to think, but not to set as an objective. It goes back to the point that James was pointing out, which is let's define the processes and the technology will align to the processes. If we want to start by saying, well, let's reconcile position and balances, I don't think you want to do real time, because this is where you will end up with a lot of noise, and that will not work. If you want to say, well, now I'm done with the position and balances, I want to go one step further and look at the activity, then you start loading activity, and this is where you may want to do real time.
So the positions and balances, T+1 was kind of where most people were saying, you know, but then have an activity, maybe an activity report in more real time to show money flows, or at least be able to track money flows. And that way you can say, well, it left here and
it all depends as to what we want to track and what the objective
and the balances movements. And the movements match on a regular real-time basis. That's what you're saying is extraordinarily difficult. Real time.
Well, it's more difficult possibly, but it's also another objective to achieve something else.
Well, balance is also a substitute for valuation as well, which I heard earlier today was I think Jerry brought it up, the valuation of certain accounts and securities in certain accounts. That doesn't happen until the end of the day. So you can see transactions happening, knowing the value of those at any point until the mark-to-market occurs is the challenge, I think. Mr. Bates.
Thank you, Mr. Chairman. I'd just like to say some of the presentation this morning, I thought all the presentations were very good. There's some particular things, but I want to pick up on this theme, which I think was introduced first by Jerry this morning. There's two issues which are around at the moment. One is the false positives, which James brought up and Pierre's mentioned, and also this issue about can you do mark-to-mark, do you have to wait till the end of the day? I think that was first introduced by Jerry this morning in an excellent presentation. By the way, Jerry, I didn't tweet your presentation this morning. As I told you, Twitter was actually down when he was presenting, unfortunately. So technology, it's so shoddy. So just a couple of points on that. I'll get to that in a sec. So the push or pull, which relates to this, I think you've got to aim for, you know, a push technology. That's the way of the world. But right now, I agree with, you know, I think it was Chris that said this morning we want to do something as soon as possible. So you can simulate a sort of a push technology using agents to go out and continuously pull data going around all the accounts. Let's say the CFTC wanted to do something that Gary introduced this morning, and he said there's millions of accounts, you were asking millions of accounts out there and so on and so forth. You can have agents. You don't have humans. You can have software agents that are going to go out and continuously pull that data. And it's starting to simulate, albeit in a more batch-oriented way, but it's more real time than just doing it once a day. So you can start to put that in right now. There would be no reason you couldn't do that. I think that's a benefit. I think you would need to have
rules engines that would look for the particular patterns that were introduced. Alan was touching on this morning. And just on the false positives, that's a problem that we've seen in many industries. Whenever you've got an alerting system, the whole point is you've got human beings, you don't have many of them, so you don't have many guys in the CFTC that would be able to do this, when I say guys, I mean men and women, of course, that would be able to do this. So you want to maximize technology to actually maximize your human benefits of the human, so you only bring them in when they absolutely need to. And that's where the false positives can get you, because they can be constantly spinning with some noise or people getting under the radar. So the way that's handled in other areas, like market surveillance, for example, which is going real time increasingly, you get patterns which might indicate things like, insider trading or market abuse, quote stuffing, or whatever it might be. But they may be just somebody it might not be insider trading, it might be somebody who got lucky. But if there's a consistent pattern over a period of time, then that might be something you would then raise the level of alert to and bring in a human being. So I'm a big fan of not just being able to find the patterns, temporal, logical, but also piece them together into an audit trail and then bring in the people, so you're sort of maximizing the people's time. So I would. And the more real-time the data is, the more quickly you're going to be able to get those high-value alerts. So there's technology that can do that today, and Alan was touching on that today. So I think that's very important. And Jerry raised, you need human review. On the mark-to-market point, if I might just address that one as well, I've also been involved with lots of systems. Jerry said you can't do that till the end of the day, and I may be missing something here, but there's lots of people who are doing real-time mark-to-market, continuous mark-to-market, so they're constantly reassessing the value of positions, and they're doing the same with risk. That's going increasingly real-time, although you can't do the heavyweight models you do at the end of the day. You can do a lightweight model to see, what might be your value at risk. So I don't know why you couldn't do, maybe I'm missing something, why you couldn't assess those pieces that you said would be harder at the end of the day. I wonder if you could take a real-time approach to that. So that's a couple of brain dumps from me, but great presentations this morning.
The real-time matchup is the problem. You need a snapshot in time to what are you comparing your mark-to-market to? Because your books and records are traditionally on a batch process. So if the regulator is trying to take real-time data, what are they going to match it to? Right now, we're going to be filing our seg reports daily. So that's what the regulators are going to try to match the data to. And I'd like to just throw in here that don't forget this is a holistic approach that the industry is taking. And Scott, in your example of the last 3 days of MF, some of the rules that the NFA Rule 16 would have put on the table is somebody at MF, the CFO or the CFO would have had to approve that movement of seg funds. Right, and I don't know if people would just go ahead and do that, but the match-off here that we're talking about, in my eyes, is a deterrent. It provides a deterrent to fraudsters and also early detection to fraudsters. So I think we have to look at everything we're doing holistically. A lot of it's already done. Now what we're trying to do here with matchups is a deterrent and early detection of fraud. And whether you need to do that real time throughout the day, I guess in a perfect world, yes. I just don't think we can get there based on books and records, which is on a batch basis today.
Well, to the prevention and the deterrence is the key here. The reporting, the Corzine rule is a great after. It's going to give our enforcement officers, a great opportunity to say, did you or did you not sign this? That's great for bringing a case. It's not good for catching bad guys before it happened.
It just seems to me, as you look at the challenge and to take small bites out of the apple. I mean, today, a point in time is more what certainly the financial institutions are used to dealing with. And you have tools that allow you to do that today, whether it's our tool or others. And they don't need to be once a year or once a quarter. They can be daily. And then you can I think, migrate as you establish the the rules from a transactional perspective where you want to dig down and build that application down the road. But at least at a minimum, to deal with a fixed point in time, balances are relatively easy. And so I really I think, align pretty much with what Jerry is saying on this one.
Oh, yeah, I was just going to say that the if you look historically at the way historically the 40 Investment Company Act, during the Depression, there were all sorts of problems with pooled investments, a similar sort of problem. The 40 Investment Company Act took the view that they created an independent entity that did the valuations. So that's where sort of the trust bank function came from in the securities market. So you don't trust the guys running it to do the valuation. Somebody does the valuation, holds the money. Banks have to do it because banks are the only guys with access to the payment system. So the structure there has worked very well in terms of the independence, you splitting those up. Now, in the securities market, then in the 60s, you take it fast forward. Before then, it was somewhat like futures with fractured clearing. Even, Board of Trade was a stock clearinghouse and stock exchange in the day before they gave up the license because they were afraid the SEC would give them trouble. But the fact of the matter is the industry then created utilities to bring it all together. And the reason for that was it was just an administrative nightmare. It was the number of securities that were running around was just prohibitively difficult. They used to have a place under the East River where you'd put all the stock certificates. So eventually they worked out, let's demutualize that. Now, the key difference with the futures industry and the securities industry is the securities industry, this is why insurance is really problematic, is securities, you basically have a security. So you can liquidate everything, see what's missing, and pay it off. Nobody's hard feeling because all you really care about is the money. That's not true in the derivatives, because in derivatives what you want is the position. So liquidating the position is the last thing you want if you're a user of the futures market. You want to keep the position open. And that's where the anomaly comes in between you can't harmonize some of this stuff. The two other simple points. First point is we're also, I think you got to be careful not to fight the last war completely. We're at a point because of interest rates where who cares about giving cash? All of us know, have been in the business a long time, this is really the exception rather than the rule. So the problems that you're assuming, yeah, you can check on the bank accounts. It's sort of honestly, this is a trivial problem. I mean, it's absurd that it wasn't done before. It's kind of enough said. But the real issue is, particularly as you go into more of the more products cleared, more sophisticated risk management products, the amount of collateral is going to get much larger. It's not going to be cash. There are going to be all sorts of haircuts. Realistically, it's going to have to be done on a batch basis because the controls wouldn't work otherwise. And I think it comes back to the trust banks. I know we'd be happy to work. We talk to our customers about this, but I think it does come back inevitably to some form of tri-party custody as the only workable solution. Now, the final thing I'd say, which is a harsh thing to say, is I just worry that we're confusing different problems. Now, the problem of fraud is one, in particularly the most recent example, is one pretty straightforward. I think if people had been doing their job competently at NFA, frankly, it would have been detected years ago. Greatest respect to Chris and the guys there. And I think creating a whole new problem beyond just not doing what you did today with the existing tools you could have prevented doesn't then argue for transforming everything. But where I do think the question of overall positions become a problem for the industry is the trading activities. And again, this comes back to the MF or the Lehman situation, because fundamentally the industry has a problem if the clearing firm goes under. There's no solution to that we thought there was in the bankruptcy, but we discovered there wasn't. And I just think we should be upfront, whether it's technology. I define technology broadly as a workable solution. There is a hole which you aren't going to fill with technology. Now, you can have technology so that Brian or Chris's guys can identify rogue firms that are at the risk of going out of business. And in fact, that's a lot of what the surveillance activities do and has worked successfully. And I think that's the focus that I would argue in particular is of the 116 FCMs. have a comprehensive enough picture as to guys that are at risk of going down, and then a relatively small number of people can figure out if things are on the up and up. But I think even in the MF situation, I would just ask a sort of hard question as to, what were people doing? And maybe the problem, and I really will shut up, is back when I was a kid in Chicago, it was much more discretionary. Particularly in open outcry, where obviously you had to watch, you had a leg breaker, watch the local, right? If you were the clearing firm, is he trading too much? You didn't have any way to really find out what was going on. But so you had to substitute judgment, the fact that you had skin in the game, and basically you would intervene, and there would be, social rules. We were talking about this in the context of Peregrine, which is everybody knew in the industry there was something off about those guys. So what went wrong? Was it the lack of technology? I don't think so. I think that, in fact, maybe the automation and the bureaucratization and the legalization of all this stuff has extracted the judgment element, which fundamentally is what you have to have, because there's a point at which you got to have a judgment as to where somebody is over their skis. Sorry, Chris.
No, I want to make sure I understand your question, because you're sort of talking about two things to me. One is whether or not NFA was doing its job, and as we've heard, 85% of the audits today are still done with paper. Now, I'm not trying to justify NFA. We're having Jenner and Block, which was very difficult for some of us that were around in '88 to pick that particular firm, but there's not a harsher industry than Jenner and Block, and they're doing we've got terrific outside directors, Mike Moscow and Susan Phillips and others on this independent committee. They're going to direct this study as to whether or not we were following standard account procedures and whether those were good or not. We're going to find out, and if we need to make some cultural changes within the organization to try to get more focused on detecting fraud earlier, then that's what we'll need to do. And we're prepared to do that. Because it's an affront to my common sense that it took 20 years to find a fraud like that. If you talk to a lot of auditors, which I've done, they don't seem particularly alarmed by it. It seems to happens all the time. But I'm alarmed by it, and I'm alarmed by it in CPOs as well, because sometimes we find these pools. NFA probably brings, 50 to 100 cases a year because some pool operator was spending the money, and it's much different than the SEG, and I understand that. But that's one question. For our industry, the harder point is that the federal government up on the Hill has basically mandated huge amounts of collateral to come into our industry, and they've asked NFA to oversee a lot of the registration and some of the processes in there. That's a different question. And so I guess I'm saying which one, I understand the criticism about the 20 years. T+1 day is a lot better than T+20 years. I get that, and we're going to get it to T+1 day. We haven't talked much about Sentinel, by the way. When I was at Pinson, we had money at Sentinel. Then my trading company had money at MF, and Peregrine owes our trading company about $5,000. So I'm the first one I found that was in all three.
Where do you have your money today?
I was in all three. If there's anybody out there, I'd like to get together and have a drink, because it's an exclusive club that I was in all three. So I get the outrage. That's a good question. Not New Edge. But,
thank you.
Right, exactly. But we're moving over to you guys. No, I get that outrage. But and I'm all for trying to catch bad guys a lot earlier. Absolutely. And at NFA, we've done three things. As I've told you, we have this study from Jenner of our accounting procedures and what went wrong, and we haven't. And there's no excuse for. There's no evidence of NFA being complicit or looking the other way. We weren't. Somebody wasn't raping children, and we were looking the other way. There's nobody that was complicit to the whole thing. Not to pick on anybody in particular, but the econ firm stuff that we came across that we were using in the industry, which was new to the industry, it wasn't that he committed suicide. Some people, I think, have said he committed suicide, and then we found out. It was because of this that he committed suicide. Now that we got now that we got the car hose out of his mouth, he'll leave incarceration feet first, I think. So we're out there catching bad guys. We got to get better at it. We got to change the culture of the institution to detect fraud and prevent fraud earlier. Absolutely.
Hi, this is Marshall, if I can speak. I'm on the phone here in New York. My name is Marshall Terry. I work for South Ferry Capital. It's a small hedge fund up in New York.
Marshall, can you hold on one second? We'll recognize you after Chris.
Yeah, I'd just like to finish this point. Our industry, because you've made this point very well, Cliff, that the industry is being told that this collateral is coming our way, and this industry needs to be well prepared to make sure that the buy side is comfortable with its money in this industry. And that's a different question than catching some bad guy that was, and 200 million is a lot different than Madoff 50 billion. We need to catch those bad guys earlier. But trillions of dollars of deposits, I'm not sure how we're going to do that. I'm not sure if that's an NFA thing that we can build an online system and check balances. So is that more your question? Or is it both?
It's both, and we agree.
Okay.
But I'm saying I think the bigger issue is the latter.
Me too.
The more topical one is this crook in Iowa. I agree, which somebody should have found.
We should have, and I agree with that.
Different question, but at the same time, let's worry about the coming new problem.
And so how are we going to do that?
I think you're going to have to leverage the way the investment industry operates today successfully here for other than CFTC regulated instruments, abroad with allowing a range of choices. The unfortunate part is some of those choices work well for institutional investors and don't work at all for an individual farmer or speculator. And that's where your dilemma is. And you've got to accommodate both groups. The kind of client that what Superna needs is quite different than what an Iowa farmer is going to do, and the problem is that to the extent that you take the client's skin out of the game completely, well, we know what the consequences of that is going to be too. That's not going to be very satisfactory either. I mean, inherently there is risk. I'm just saying that I think the next big risk is going to come from the clearing firm's overall financial viability. You're talking about exponentially bigger numbers they're going to have to handle, and who's going to watch that? So I don't mean to say too much.
Let me go to the phone. Marshall? Marshall, you there?
I'm there, thanks.
All right.
So I work for a small hedge fund up in New York. We're a credit shop. I am in no way a futures expert. But when I got the email from on this meeting, the first thing I did is I went and looked at the NFA site, and I looked at Peregrine, which is interesting today. It says that if you look at the site, Peregrine is still approved, which is interesting. So what I'm trying to do is say from like a user's perspective, looking into this, if I was that farmer in Iowa, I like the fact that the NFA is thinking about these things, looking to input technology, so on and so forth. But just what's available to me to kind of just assess whether or not the FCM is legitimate or not, I think is somewhat lacking. I mean, again, I look at the Peregrine website today. It still says it's an approved dealer, a member, Forex firm approved, notice broker, dealer, registered. So that hasn't been updated, which is interesting. If you click through the regulatory actions, then you kind of see it, which is interesting. But more importantly, when I looked at this, I talked to our auditors. We're audited by EY. When I first read the fact pattern on this, and what they do what we do, frankly, as a buy side, we have to have an independent audit, and those auditors, frankly, I know this is not a high technology lift, but they independently check with each bank relative to how much money's in the account, which is I think the gentleman before is alluding to this, that's a fundamental issue that seems to be overlooked here. And I would argue that maybe if someone in the world of Madoff had done that, or frankly, I don't know enough about MF Global, but clearly in the case of Peregrine, we might not be on the phone right now. So I think it's great that we're making these initiatives towards better transparency and technology. But I do think I'd be curious to know if there's anything just fundamentally being done on the front end of it. The other thing I would add is this concept of, I was talking to our counsel, and she has this concept of a health check, meaning that a farmer comes in and he picks Peregrine. He or she has no idea what service providers that FCM uses to audit its books and records, so on and so forth. In other words, without showing any negative, to a smaller audit firm, but E&Y, from what I know of them, has a very comprehensive set of audit procedures, whereas an auditor in a single shop in Iowa may not. And those are the transparency issues. I think if I was a farmer, again, sitting in Iowa, I would like to know. It's much like in New York, we have this health, with this grading on food vendors. There's some type of matrix that's put together. I don't know if they run an algorithm, whatever it is, but it runs A through D. I know I'm not eating at D. So just something on a little different side of the equation, meaning from a user perspective. The only other thing that I'll concede the point is with respect to this transparency technology lift, having spent a lot of time in the OTC space, what we tried to accomplish there with respect to reconciliations was, 08, 09, prior to that, very, very similar type discussions. And the solution that came out of the whole Fed mandates and what have you, this entity TriResolve, which sits in the middle, which is a utility, although not a hub, it's a utility. The bigger issue is once you have all the data, how do you actually scrub it? That's where that plays out today. But I would suggest you look and you talk to folks that spent time in that space, because we were trying to solve for a lot of the same issues, which we had all these disparate systems that didn't speak to each other. There was no interoperability, so on and so forth. Whereas in the OTC space now, at least you do. I can go, and I do every day, look at all my my OTC positions at a position level, mark-to-market level, so on and so forth. So those are my 2 cents on it. So I'll concede the phone at this point.
Great. John?
Yeah, I'd like to take it back to just a 10,000-foot level for just a second. The presentations were great. The discussion is really good. But I have not heard anything yet that would reassure a customer and bring back confidence in the markets. What I've heard is a lot of catch-up. Okay, we should have been doing this. We should have had electronic statements or access to this information like I can get on a retail basis or whatever. I've heard about the insurance, which I think is a good idea to look at. Because quite frankly, and as I mentioned in the last time I was here, the perception at the retail level, okay, and believe it or not, there are retail traders, and we've had 2 blow-ups of retail firms which have had a substantial impact upon our industry, perhaps even greater than the level of participation that they have in our industry, okay? So they're important to the ecosystem. But those people right now are choosing not to trade futures. They're choosing to go into a security product or go to a securities firm and keep their money in a securities account. And if they have to trade futures, they just move enough into their futures account to be able to margin that position so it's up at the clearinghouse, and then they sweep everything back over to the security side. Now, that the market is moving. It's making up its mind. It's voting with its feet. That's exactly what's supposed to happen. We don't have to have securities and futures necessarily be 2 separate worlds. Maybe this is where they're starting to morph into a single world, and the regulation will start to follow it. But we are losing liquidity, which is a public good, from our markets because of this. And so we have to figure out a way to restore the confidence in our markets. One of the things that Mike talked about, being around a few years here myself, the list isn't just MF Global and PFG, it's also Sentinel, it's also Revco. And this whole incidence here has basically torn away the scab that was Revco. Okay, and so it's fresh in my mind, at least. And so you have to say, okay, well, this would have worked on MF Global, but it wouldn't work on Paragon, which begs the question, would it have worked at Revco? Now, we're talking about doing all kinds of great things in order to help the audit process here, but the fact of the matter is that we had a fraud in this industry for 10 years with Revco that company went through a process of having a private equity investor with their money on, their skin in the game, buy into that firm and do an audit. And then we had that firm go through an IPO process and go through the rigorous IPO auditing, okay? And it was only after the fact that it became a public company and they had made a mistake that the error was found, okay? Think about that. Cliff said they spent $10 million on all of the audits for Revco between the private equity and the IPO. So are we going to spend $10 million? That's $10 million to be ineffective. Okay, we don't have that kind of money to spend on every single audit. Okay, so we need to be thinking bolder in terms of how to capture the public's imagination about the solutions to restore confidence. Technology is absolutely part of that, and I believe that, but the processes, as Jim pointed out, are really important too. We can't just go, oh, there's a company that offers confirmation, and so we're gonna use this company now, and they're gonna confirm that. The regulators could do the same darn thing. Okay, they just have to have the will to be able to do it, and they have to have the training upon what to know with it. I got up at 2:30 this morning to get here from Boy Scout camp in